Then the question is, what do they say about it all? I mean, I assume that Christine Lagarde is going to say we're not done because they've got a bigger problem than we do. But could Jay Powell say we're close to the end now, we might do one more, or we'll see what the data tell us? We'll have 2 jobs reports, 2 CPIs before the next Fed meeting in March. And so there could be data that say you don't move. Does Powell want to upset the markets? I mean, you got the yields going in the right direction today for the Fed. Tighten things up a little bit. Does he want to really surprise people?
Going in the right direction marginally by a couple basis points after fluctuating around the same level for about a month now. At what point do they get concerned about the easing of financial conditions, or do they not really care because the data is moving in their direction?
I think they're probably closer to not really caring because the data is moving in their direction. It's hard to know exactly what it would take to get financial conditions tighter. Maybe if Powell came out and said we're going to go to 6% or something like that. But at this point, you've got 450 basis points, another 25 coming, and we're still seeing positive financial conditions. It doesn't make a whole lot of sense, but you're right, data's going in the Fed's direction, so well, why mess with a good thing? If it ain't broke, don't fix it, as the man said.
Mike, end of August, you were there with us, Jackson Hole, Wyoming, that very short, blunt speech. How long was it, 8 minutes, Lisa?
8 minutes.
8 minutes long, and that word pain came up in that speech. He said, while higher interest rates, slower growth and softer labour market conditions will bring down inflation, they will also bring some pain to households and businesses. I'm looking at jobless claims and just asking, where's the pain that he was talking about 5 months ago?
Well, it's starting to come. You're starting to see a lot more layoff announcements spread outside of tech. It just takes a while for all of that to hit the data. But so far, what we're seeing is basically companies rationalizing their workforces rather than reducing their workforces. If you can parse that distinction there, we're not seeing mass layoffs because business is bad. What we seem to be seeing is layoffs as companies restructure to look to more profitable areas. They're not trying to get rid of a lot of people because they had such a hard time finding them after the pandemic.
You down in Washington Wednesday?
Be down in Washington Wednesday and try to keep you informed on what's going on.
Looking forward to it, Mike. Looking forward to it. Mike McKee there on the latest. Mike's going to be down in Washington on Wednesday in that news conference with questions for Chairman Powell, no doubt. Joining us now is Bruce Kasman, Chief Economist and Global Head over at Economic Research in JP Morgan's house. So let's talk about the house view over at JP Morgan, Bruce. Can we talk about where you see this Fed going? And when Steve Major of HSBC talks about the penultimate hike, is this hike this Wednesday the penultimate hike of this cycle?
Well, we, as most people, think the Fed's going to go 25, and I think it's going to be a Fed that continues to talk about the need to do more. However, I do think, as the data is showing a moderation in inflation and some cooling in labor demand, I think the Fed's getting more comfortable and probably will hint a bit at getting closer to a pause. I think we should recognize, though, that the pause is not going to be because the job is complete. It's going to be because the Fed is hopeful that the lags in the monetary transmission mechanism will deliver its results. So thinking about whether the pause is actually the last tightening by the Fed, I think you have to ask yourself, where's the economy going to be 6 or 9 months? And we're not as comfortable as I think the market is that the Fed is done here, that they will get inflation under control, that we will have a recession, that all the dynamics that are going to keep the Fed on hold and maybe ease are going to be realized.
Bruce, just to get in the weeds just a little bit, we won't get the projections on Wednesday. We will have a statement. There is this line in the statement that says ongoing increases. Do you think that line sticks on Wednesday?
I think it's a close call. If they're going to shift it, they'll probably shift it to something like further, which will be kind of diminishing the magnitude of what they're talking about, but not losing sight of the fact that they have more work to do. But again, I think they want to be hawkish here. As you mentioned, there is an easing in financial conditions that they're at least somewhat concerned about. They don't have to tell us that they're going to pause. If a pause is going to happen after the March meeting, which really means leading into the May meeting, they may not move. There's a lot of time, a lot of data. They don't want to, validate significant further easing in financial conditions. But I think they're getting closer to a resting point that's based on hope that the lags in transmission mechanism will deliver more, because we're certainly not where the Fed needs to be in terms of its objectives.
Bruce, you push back against this idea of the immaculate disinflation, that there would be this ongoing decline in inflation that could even get us back to 2% by the end of this year. What would be the driver of that renewed inflationary aspect in markets?
Well, it's not so much a renewed inflationary aspect. It's just that the disinflation we're seeing right now, which is largely an unwind of supply shocks and some other forces around weak goods demand that we've seen, that's going to be there's going to be a cushion to that. There's going to be a limit to that in a world in which labor markets are tight, labor costs are still rising rapidly, and inflation psychology has shifted. So we think inflation will come down into the low to mid threes, but I think it's going to be hard to get it down to the low to mid twos without a much easier labor market.
How do you understand this idea that we're not seeing a real loosening in the labor market, that tightness seems to be pervading all of the reports, even as we hear increasing anecdotes, not just in big tech, but even at smaller companies of layoffs and other cutbacks?
So I think the tech story is somewhat specific. Tech was a high flyer and is now coming down to earth. I do think what you're seeing in the data is a bending in business behavior in the face of what has been weak demand and tightening financial conditions from the Fed move. You see the hours worked numbers having cooled quite a bit. But I think businesses are very healthy. They've had excess demand for labor for some time. They're not going to start shedding labor pretty rapidly here. So if we're right, and what happens in the next few months is the tightening in financial conditions that we've had from the Fed continues to work, but it's being offset by fading supply shocks, a pickup in China and Europe, the dynamics of a healthy household sector that responds to that. And I think this week's auto sales number is going to be interesting in that regard. I think what you're going to see is a labor market that stays tight, and you're going to see labor demand that holds up, and for fundamentally good reasons.
So, Bruce, let's just put some numbers on things, just briefly. Where do you see Fed funds ending up?
Well, we have the Fed pausing at 5 after a March move, but we're kind of pretty even in our own forecasting of scenarios of whether that's going to be the end, or the Fed's going to have to sometime in the second half of the year think about raising rates again. And I think that scenario is the one we want to consider, partly because the market is so far off of that in its pricing right now.
So, Bruce, that's going to bring potentially a lot of volatility if that is the case. You mentioned China as well. Can you tell me how China's reopening maybe influences the way you think about some of these issues?
Well, I don't think China influences the big call right now, which is how much softening we see in the U.S. corporate sector as it's turning into the new year. That we have to be broadly right, that bending but not breaking is taking place. But if we're sitting here in 3-4 months and the U.S. Corporate sector hasn't broken, if the benefits of lower inflation is helping consumers, then the China reopening, which we think is largely going to be a demand impulse, is going to have an impact on commodity prices, is going to have an impact on goods prices globally, and it's going to add a reflationary impulse to the U.S. as well as the global economy.
Bruce, you talk about how perhaps we're not going to get a recession this year. Is that a recession deferred that's going to mean that the recession that comes, say, in 2024 is going to be worse? Or is it just pushing it out, lengthening the timeline in a cycle that people thought was moving a little faster than it is?
So we don't think we're going into recession now, but I think the risks of going into recession later this year in 2024 are quite high. And I think part of it is simply there are still lags in the transmission mechanism. But the bigger issue here is if we are in a situation where inflation is sticky, labor costs particularly are sticky, and the environment remains one where the Fed has to stay higher and higher, then I think gradually you're going to build the vulnerabilities that could cause a recession. And I think the point to make there is that while we tend to think that this recession is going to be mild, and it will be mild when you look at the GFC event, which was off the charts, if we have a recession in late 23 into 24, and it's coming with synchronized monetary tightening that's resuming around the world, I think it's hard to see that as being a mild recession in an overall sense. And I'd push back against the idea that recession that's going to come here is going to be mild by any circumstances.
Bruce, this was deeply thoughtful stuff, and we appreciate your time, sir. Bruce Kasman there of JP Morgan. Bruce Kasman there, not constructive on the outcome for this economy down the road.
Not down the road. Sort of the near-term constructiveness leading to longer-term, more difficult period. I mean, this to me is sort of the interesting dynamic of people who are pushing out their forecasts. It might mean more pain later because, as Bruce was talking about, the synchronization of tightening as well as a recession, as well as a downturn with the vulnerabilities that have built up over a year.
The resiliency of this labour market, front and centre in this conversation. Andrew Hollenhorst, The City, publishing just moments ago. So many people publishing this morning to kick off a really busy week. Andrew had this to say: we expect upcoming stronger core inflation to challenge this most recent version of the transitory inflation narrative. That's the latest from Citi.
Yeah, they've been talking about this for a while. They think that inflation isn't going to roll over so quickly. And so then you go into the distinction between sort of the deceleration in inflation that was expected and when is it enough to be continued to sort of have the sustained momentum to go beyond 3%, 2.5%, or closer to 2%. And does it matter? Is the Fed going to really double down to get to that 2% if you do start seeing more pain.
And I'm guilty of saying this every single Monday, but what a week coming up.
There have been a couple Mondays we haven't said that.
You could probably cut that and just play it out every Monday for me just saying, what a week.
This is an important
coming up.
week. This is
Last week was a bit of a snoozer. This week's an important week.
Is that what you went to
It was
London?
a bit of a snoozer.
You're like, it's all about you, London. I was going to be here.
Bit of a snoozer.
Yeah, it wasn't.
That's why I was absent. Just
Yeah,
total snooze.
It wasn't that snooze.
Futures on the S&P down 1% on the S&P 500. Yields a little bit higher. Euro dollar close to 109. In the next hour, Jordan Rochester of Nomura on the ECB and this FX market. Looking forward to that conversation shortly.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden will meet with House Speaker Kevin McCarthy Wednesday to discuss raising the debt ceiling and avoiding a U.S. default. Republicans want a deal that includes government spending costs. The president has refused to negotiate over the debt limit. In Germany, the economy shrank 0.2% at the end of last year. And that was worse than expected. And it makes a recession more likely after all. Soaring inflation, in part due to higher energy bills, has weighed on German household spending. Billionaire Gautam Adani's attempt to restore confidence in his business empire is falling flat with investors. Shares of most Adani Group firms slumped again today. The sell-off has now erased about $68 billion in market value. Over the weekend, Adani issued a 413-page rebuttal to allegations of fraud by short seller Hindenburg Research. Job cuts are on the way at Royal Philips. The Dutch maker of medical equipment is cutting 6,000 positions. That's about 8% of its workforce. That comes on top of 4,000 job cuts that were announced last year. Philips is reducing expenses while dealing with costly recalls of some of its consumer products. And Renault and Nissan have agreed to reorganize their more than 2-decade-old alliance. The partners will each retain a 15% cross-shareholding, with Renault transferring the remainder of its stake into a French trust for a coordinated sale. The deal still needs approval from the company's boards. The Japanese automaker will also invest in Renault's electric vehicle and software business, Ampere. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
This is Bloomberg.
We think that the global economy is in a relatively good shape, and we expect to see a soft landing in the US, but we also now expect to see a relatively soft landing in Europe. The falls in gas prices have helped, the pickup in China as well. But the absence of recession, as you say, doesn't mean we're yet into a strong recovery cycle.
Fantastic to catch up with Peter Oppenheimer there, Goldman Sachs' chief global equity strategist over in London just last week. There is, of course, a difference between recession and stagnation, but there is also, of course, a difference of stagnation and recovery. And I think getting excited about stagnation, Bramo, I find slightly difficult.
Well, less disappointed about a stagnation than an outright recession. Perhaps this is really the issue that you were asking a lot of people. Are we just seeing people just close out shorts, or are people actually getting long? And that's really underpinning some of the questions. Although, if you could check out the U.S. and international investors, it's getting long Europe, and it's getting long EM.
I keep hearing these stories, reading these stories, these headlines. How can you get long the reopening story? And I'm sitting here like, it's been going on for 3 months over in China. I looked at Alibaba on the charts last night, 87% higher from the October lows in 3 months. Lisa, I think another question you could ask is not where do I want to be for the reopening? Have we seen the reopening trade already take place in the last 3 months?
It's a great point, especially as people start talking about everything that's going to end up happening. There was one interview with Boeing's CEO basically saying that air travel is going to return to about 90% of pre-COVID levels because of China's reopening, boosting it really substantially. Have we seen that fully played out in the shares?
I think Guy's going to catch up with Boeing later this week, isn't he?
I think
Guy
so.
Johnson.
Yeah.
Looking forward to that. Then he's dropping by New York, you know. Couple of days.
Guy or
Guy.
the Boeing CEO?
Not the Boeing CEO. I care more about
you care more
Guy's
about Guy.
movements than
That would be wonderful.
the
I'd
Boeing
love to
CEO.
catch up with Guy.
We can talk to Guy about Europe. We're going to talk to Maria Tadeo about Europe right now. Maria, great to catch up with you as always. Spanish CPI comes in hot. German GDP comes in soft. What's more important for the ECB this Thursday?
Look, at this point, and it's not because I'm Spanish. By the way, I used to be the Spanish eco reporter. This is a data point that I cover religiously for almost 2 years of my life, but it's not a bias. It's just this is a single mandate central bank, and obviously it's about inflation. If you look at the data coming out of Spain today, inflation accelerating 5.8% in January. We're expecting a cool down. We got the opposite. When you look at core inflation, also sticky. I should note, however, and this is very important, when you look at Spain, which a lot of people in the market look as a forward-looking indicator for the rest of the euro area, is that core inflation gets measured differently in Spain. But to answer your question, at this point, it really is inflation. If you look at everything that Madame Lagarde has said for the past, 4 weeks, is that it's all about inflation. The ECB has a job, and that is to bring it down to target.
Maria, you follow the commentary from ECB officials far more closely than I do these days. Can you tell me how much division is there on the Governing Council?
Look, I think the thing that to me is very striking is that she came out very hard in December. You remember that press conference. She said the job is not done. We have to get inflation back to target. This is not hit and remove. This will be hit and stay the course. And there has been very little pushback from the doves. You've not really heard a lot on that. I think when you look at Thursday, and that is, of course, a big meeting, the market is expecting another 50 basis points hike. The real question will be, will she signal another 50 basis points come March? If you look at the data out of Spain today, you could argue the hawks have it. They have an argument to say we have to continue to hike around 50 basis points.
To build, though, on what John was asking about, Germany looks like it's poised for a recession. So even though you are seeing optimism in Spain and some of the other economies, the biggest one of the Euro region is struggling. Does that color the conversation at all and sort of temper how much the ECB will go?
And look, that's a very good point, because sometimes we talk about this European recession. And European recession, do you mean Germany or do you mean the entire euro area? If you look at countries like Spain, Italy, France, there is no signal of recession. Basically, the economy is not in a recession, but Germany is obviously the biggest one. If you look at German policymakers, what they'll tell you, however, is that this recession will be shallow, will be short, and their own focus is on inflation. You look at the German central bank, they continue to bang on around inflation. So really, I know that this may seem a binary conversation as a growth, as an inflation, but at this time around, to me, it really seems, come Thursday, again, on the bigger picture, it really is about bringing down inflation to target, respective or regardless of what the economy is doing.
Just to dig in a little bit more, how much of the increase in inflation that was unexpected in Spain had to do with fuel costs as well as tourism? I mean, there's just a weaker euro and people coming in and flooding the region with money.
Look, I think that's a good point, too. When you look at the tourist season, of course, you have the big China reopening. We know that countries like France, like Italy, like Spain, too, are big hubs for Chinese tourism. You have two big events happening in Q1, which are, of course, Fashion Week and Carnival. I wish I had time for both. I have time for neither, but nonetheless, that could play into this. But it's still too early to say whether that had an impact. You also had a number of national measures that came off by the Spanish government at the end of December, a subsidy on fuel. Again, this was a flash reading, so I want to see the details at the end of the month when we get the confirmation. But I would still stress this point. Car inflation also includes some elements of food in Spain, so you have to treat it differently.
Lisa, it was amazing going through these conversations last week and all this, let's call it, relatively speaking, constructive optimism around the European story, avoiding recession, and then reading the front pages of the European papers about the war taking place in Ukraine. It's almost like on Wall Street and in financial markets, there is some kind of fatigue when a story goes on for too long. It's still happening in Ukraine, and some people might argue, based on the events of the last week or so, things are escalating.
I would agree with that. A lot of people are very concerned about trying to get ahead, the offensive by Russia to get ahead of some of the weaponry that Ukraine's going to get from both Germany and the U.S. What that means, you have Olaf Scholz making noise of potentially trying to have some discussion with Vladimir Putin because this is dragging on and the deaths are just catastrophic.
Maria, can we come to you on that? What is the latest on that front? People are very constructive, relatively speaking, about what's happening with the economy. Can you say the same thing about the war in Ukraine right now?
Well, Jonathan, if you look at the words of President Zelensky yesterday, he's painting a grim picture. He says Russia is willing or potentially preparing a new offensive. Remember, it's coming, that 1 year mark of the invasion of Ukraine, potentially something to show to the Russian people may have to come. And yesterday he sounded worried. He said we need more, not just weapons. Of course, he has the tanks, but we need more. He also obviously talks about the fighter jets. He says the war is going on. It has not gone away, and time again could play into Russians' hands. He repeated yesterday so many times in that speech that he publishes pretty much every night. We need this stuff now. It really is about the speed now and who gets the upper hand.
Maria, this was great, as always. Thanks for your time. Maria Tadeo there of Bloomberg over in Brussels on CPI, the ECB, a war in Ukraine, and apparently on Fashion Week as well. And what else was it? Carnival?
Yeah, I don't want to put those things all together, but I do think that there is this issue that you raised, and I think it's an important one. The geopolitical risks that people aren't talking about, perhaps because there's fatigue. And you talk about this war that continues to escalate on some levels, and you talk about sort of a widening question of the geopolitical arrangement with Russia's support of Iran, the recent attacks of Iran, what that could mean for oil. I mean, if you look at some of the peripheral discussions and you talk with certain macro traders, they're focused much more on this than it might seem.
For Europe specifically, the overwhelming consensus is the ECB hikes more than the Federal Reserve this year. I went back to my comments, the notes I made for ECB President Christine Lagarde in the meeting in December. We're not pivoting. We're not wavering. We have more ground to cover. We have longer to go. We're in it for the long game. Right. She's just going to repeat those comments all over again at this meeting.
They have more oxygen, though, than the Fed because they're at less lofty levels, right? So then there's a question, is the Euro region going to function well with, say, a 3.5% overnight rate versus the 5% overnight rate that will be the peak for the Fed, right? So in other words, where is their limit? And is it a lot lower than the Fed, but they might hike more because they're further away from it this year?
Never mind 350. I never saw them getting to 250. No way.
Well,
no
right
way.
now,
Even 12 months ago, you said 250. I'd have just laughed. The ECB hiking interest rates, I would have laughed at that. The ECB getting to 250, I would have laughed at that too.
The fact that there's been an ongoing sustained recovery, or at least not a full-out recession, in the face of two-year German yields at 2.6% is really pretty incredible, I got to be honest.
And maybe the inflation backdrop in Europe being stickier than some people think relative to the United States. We want to all put this in one bucket and maybe just say the ECB is 6 months behind, CPI is going to roll over. I wonder how different the experience in Europe might be in the next couple of years.
From your perspective, the strikes that we see, the labor unrest in Europe, not only in UK, but also in France, how does that play into the stickiness of this inflation?
Don't know. It would be interesting to see. I think that union membership is a big part of this. And I think that if we had the union membership in this country, in the United States, that we did back in the 70s, I think we would have seen a very, very different backdrop here in America.
I mean, in terms of stickier wage inflation?
Without a doubt.
Although
the pass-through would have been huge.
Although we are seeing more wage inflation in some of the lower wage jobs than even the higher wage jobs at this point. So that's kind of, on the margins maybe.
Equity futures right now on the S&P down about 1%. Massive week ahead. Federal Reserve decision on Wednesday. Payrolls report on Friday. Earnings from Meta, Amazon, Google, Apple. Take your pick. Just ridiculous this week, isn't it? All coming up a little bit later. Full preview still ahead. Looking forward to catching up with Ken Tropin, the CEO of Graham Capital. We'll do that next right here on Bloomberg Surveillance.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Mitch and Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We think structurally returns more broadly are going to be lower.
We think that the global economy is in a relatively good shape, and we expect to see a soft landing in the US, but we also now expect to see a relatively soft landing in Europe.
The Fed is beginning to kind of adjust to the fact that the economy is weakened and that it views itself as being in restrictive territory.
I think the market is probably severely underpricing what the Fed may say. I think they are likely to be more hawkish.
The market is actually, in my view, underpricing the risk of hikes for this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Massive week ahead, so TK took the day off from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Counting you down to a massive week ahead with the Federal Reserve on Wednesday, payrolls on Friday and some earnings in between. Equity futures right now, Bramo down 1%. We've already got the big debate on Wall Street this morning. The South Side already publishing. On the one side, you've got Mike Wilson of Morgan Stanley, Mislav Matejka of JP Morgan. On the other side, Max Kettner of HSBC saying you should chase this. Steve Cheverone of Federated Hermes, super bearish through most of last year, saying he was jumping on board with the rally so far this year.
That's what I find interesting. The biggest bears are actually going in on this rally because they don't see a reason for it to stop. Just to give that sense of the polarity on the bond side, you've got Stephen Major on one side saying we might be close to the penultimate rate hike, which could signal a sustained bond rally. And then you have hedge funds boosting their short positions on treasuries to a record. So again, this question around the push-pull of whether the Fed can really push back against a market and data that seems to be moving in the direction they want.
A 10-11% rally on the NASDAQ 100 would change the narrative pretty quickly, and that's what's happened in the first 3 or 4 weeks of 2023.
The bulls on the tech say that the job cuts that we've seen actually give some tailwind to this, that they're actually making the cuts necessary, and other people are saying this is just the beginning. And if you start to look at the chip sector, that indicates there's a lot more pain to come with the lack of investment in some of the areas that we saw during the peak of the pandemic.
The weakness is being pushed out. Mislav Matejka of JP Morgan acknowledging what could happen in Q1, in their view, will likely mark a turning point as the fundamental confirmation for the next leg higher might not come. Mislav going on to say, and instead markets could encounter an air pocket of weaker earnings and activity as they move through Q2 and Q3. What happened to just the first half that was just going to be absolutely dreadful, and a second half that was going to deliver this big recovery?
What's the saying that the market likes to exert the maximum amount of pain on everybody, so it will just immediately flip? And I do wonder how much the consensus heading into this year of dip and rip really got turned on its head because of the consensus positioning. People got too far ahead of themselves amid data that still wasn't that bad.
And all of a sudden it's rip and dip. I can't keep up. Futures right now on the S&P, we're down about 1% on the S&P 500. Equities lower after a massive month of gains still in store for January. The Nasdaq up about 11% coming into Monday. EM equities up about 9.9%. Euro Stoxx 50 up about 10%. This is year-to-date stuff, so this is 4 weeks. The S&P 500 up about 6%. That is still pretty decent. Yields look like this in a bond market, up 5 basis points on a 10-year, 355.51. Euro dollar just about holding on to levels in and around 109 at 108.99, positive a third of 1%. The data out of Europe, Lisa, we've been through it a couple of times, but if you are just tuning in, Spanish CPI came in hot and German GDP came in soft.
So basically, it's stagflation, as you mentioned, which isn't necessarily outright recession in the region. So perhaps, yay, go long. That seems to be the trade for a lot of people. This week, let's talk about what we have on the docket. The FOMC rate decision is on Wednesday. We are doing a special on that, which is perhaps why Tom took the day off today. Bank of England and ECB rate decisions come on Thursday. Do we see a real bifurcation in the message from the Federal Reserve, perhaps taking more of a Bank of Canada tone, and the ECB taking a let's go kind of Fed last year tone? Earnings. To me, I think the earnings might be even more important this year because this week, I should say, because tech has led so far in 2023. Can it continue after the behemoths report? We've got Meta on Wednesday, then we've got Apple, Amazon, and Alphabet all on Thursday. I'm curious about cloud computing. I'm curious about Amazon and its layoffs, who they're cutting, how they're reducing expenses at a time when a lot of people are looking to them as perhaps some sort of bellwether for the employment picture. And then on the data front, we get JOLTS data on Wednesday. Thursday, we get non-farm productivity and jobless claims. And on Friday, we get both the January non-farm payrolls report as well as, and you pointed this out earlier, the ISM manufacturing and services sector data. You put this together, do we start to see some softening in a jobs market that has really been resilient to date?
Fantastic week ahead. Huge stories.
Huge stories. It'll be a roller coaster.
Payrolls, the Fed, the ECB, the Bank of England, and some earnings in between. Joining us now to discuss, I'm really pleased to say, is Ken Tropin, the founder and chairman of Graham Capital, a hedge fund with $18 billion under management. Ken, fantastic to catch up with you, sir. Thanks for being with us. Let's start broad.
Thanks for having me.
The amount of central bank tightening we've seen over the last 12 months, there is a feeling that we can get away with something mild, something short, and then just move on. Ken, do you share that feeling, that view?
I think that's too optimistic, personally. You know, if you think about how 2022 compared to the previous decade, in the period between the end of the financial crisis, 2010 to 2021, we saw a total of 13 25 basis point equivalent rate hikes between the ECB, the Bank of England, and the Fed. In 2022, 1 year we saw 40, 25 basis point rate moves. Obviously, some of them came in 50 or 75 at a crack. So you've seen an enormous sea change in financial conditions, and I don't really think the market reflects that necessarily in equity valuations.
So how would you lean against it? I mean, would you basically move against some of the tech rally? Would you just go more into bonds?
You know, I think it's a good time to be very conservative. I think one of the things that I think about is that for the last 11 years prior to 22, you were sort of rewarded for buying every dip in equities. I think that is the psychology of investors broadly. I think that psychology probably needs to shift. I think a 10% rally so far this year in equities seems like, okay, there was a big sell-off last year and people wanted to get back in with the sense that the Fed was going to start easing in the second half of the year. We're not so convinced that they're going to ease in the second half of this year, and there's still a lot of rate hikes priced in between the Fed, the ECB, and the Bank of England. So I would be really cautious personally.
What does it mean to be cautious, Ken, at a time when last year the 60-40 didn't work, and frankly, the bond component of the portfolio had the worst year on record if you look at certain denominations? Is this a renewed time of that being a haven trade, or is that still really a difficult area?
I think it's a difficult area. I like the 2-year, you know. You've got the yield curve really inverted here, and so I think to be in 1-year notes and be patient makes a lot of sense. As you said, last year was the worst year for a 60-40 portfolio since in 37 years. I mean, it's crazy.
Ken, are you thinking inflation is going to be stickier than people anticipate? Is that what you're positioning for?
Somewhat stickier, yes. I mean, it is definitely cooling, but, you know, energy prices haven't gone down that much. They've come off their highs. But if you think about the world we're in, you know, there's not any energy development in the United States. Green policies, which we probably need because of global warming, really discourage more energy development. So resources are tight in inflation. If you look at labor, certainly there's softness in tech and finance. On the other hand, CVS and Walgreens are limiting hours because they can't get enough employees. So I'm not convinced that we're going to see inflation get anywhere near target as soon as the market would like.
Again, where does that leave the yield curve right now? Deeply inverted. Some people think we can get that return of the bull steepener because the Federal Reserve's going to cut, save the day, deliver that steepening that we traditionally get. Ken, are you pushing back against that too then?
I think the yield curve's moved a little too much. You know, for all of the years I've been in finance, there was term premium and duration risk priced into bonds. There is none today. It's the opposite. That doesn't make a lot of sense to me if you think we have some inflation that may be around longer than another 6 or 12 months.
Ken, we've been talking a lot about anecdotal signs of weakness in the labor market, whether it's big tech or even the big banks that have been cutting jobs on the margin. From your experience, do you think that those anecdotes reflect a real softening in the labor picture, or do you think that there is more sustained strength than people realize?
I think it's bifurcated. I think in high income and in jobs such as tech and finance and what have you, there's definitely softness. And I think in the service sector or, you know, in more blue collar jobs, not so much. And I also think we have the psychology of a lot of employees who are younger, who have never, you know, endured a recession. And so they're being very patient about looking for jobs if they're laid off. That's a new phenomenon, I think.
Again, just a final word from you. Your favorite trade this year, and you do not get to say the 2-year because you've said that already. What is it, Ken?
Well, the 2-year is not a trade. It's just a good place to be conservative. Sure. I think if I had to pick one thing, after stocks have gone up 10%, I probably would lean short.
You'd go short right now?
We're mixed. Some of our quant systems are long equities, while our discretionary traders are basically short.
Is there a part of the equity market, Ken, that you think needs to be shorted more than most?
I think, well, if you look at the Hang Seng, that's gone up an enormous amount in the last 3 months. That looks really expensive to me. And I think broadly in the U.S., if we are going to see a recession sometime this year, I don't think that's priced into the S&P at all.
Ken, this was great. Isn't it nice the macro's back, Ken? Don't you agree? Isn't it nice? It's
you
back?
know, it's the most exciting time to be in macro in 15 years. There's so much going on between what's happening in the Ukraine, what's happening in inflation, all of these rate hikes. You know, it's kind of a lifetime opportunity, or who knows? You never know exactly what happens, but it's really exciting to be in macro.
Well, Ken, it's exciting to talk to you, and let's do this more often. Fantastic as always. Ken Tropin there of Graham Capital, a hedge fund with 18 billion AUM. Bramo, leaning against maybe some of that equity market rally we've seen so far this year.
The Hang Seng was an interesting point, this question of how much, and you asked this question earlier, John, how much we priced in already the reopening trade and perhaps even gotten over our skis before actually seeing the data on the ground and how that opening will actually manifest itself.
Take Baba, we're talking about 80-90% moves in 3 months. 3 months. And we're coming into 23 and people are talking about the reopening trade. Like, it's been going on since the start of November.
Other people would say, well, look at the carnage last year. And this really is what Ken was talking about in terms of pushing against this idea that stocks will always go up, saying, you know, well, you know, we still have a long way to go before we can recover all of last year's losses. So let's go.
It takes a long time to recondition the psychology of market participants.
That's evidently it
Not
does.
just a 12-month sell-off. Equities right now on the NASDAQ, lower on the S&P, lower too. We're down 1.2% on the NASDAQ 100. On the S&P, we are lower by about 0.9%. Coming up in the next hour on the bond market, Tony Rodriguez of Nuveen. Interesting to hear that comment from Ken there about maybe the 10-year yield is a little bit too rich, a little bit too low.
The stickiness of inflation.
Yeah, Andrew Balls of PIMCO last week in London said that could be the big risk for 23. All of that coming up, and AMH on the other side of a commercial break. Looking forward to catching up with Anne-Marie down in DC shortly.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. In Iran, authorities say that a drone attack caused a heavy explosion at a Defense Ministry ammunition depot. The attack happened in the city of Isfahan. According to the Wall Street Journal, Israel carried out that strike. The Journal says the aim was to look for new ways to contain Tehran's nuclear and military ambitions. In the UK, Prime Minister Rishi Sunak says he cannot raise taxes to fund pay hikes for workers in the state-run National Health Service. Sunak told an office of healthcare workers that, quote, nothing would give me more pleasure than to wave a magic wand and have you paid lots more. Nurses and ambulance workers are both planning strikes on February 6th. The Federal Reserve is set to shrink interest rate hikes again this week. Policymakers are likely to raise their benchmark federal funds rate by a 0.25 percentage point on Wednesday. That would follow recent data suggesting the Fed's aggressive campaign to slow inflation is working. China is urging House Speaker Kevin McCarthy not to visit Taiwan. Beijing raised the specter of a repeat of last year's showdown when McCarthy's predecessor, Nancy Pelosi, made her own trip to the island. McCarthy had pledged to make his own trip to Taiwan if Republicans took control of the House. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
A pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
They said he's not doing rallies, he's not campaigning. Maybe he's lost that step. I'm more angry now, and I'm more committed now than I ever was. There's only one president who has ever challenged the entire establishment in Washington. And with your vote next year, we will do it again, and I will do it again.
The race for 2024. The former President Donald Trump speaking at a rally in New Hampshire and South Carolina over the weekend. Let's head down to Washington, D.C. and catch up with Bloomberg's Anne-Marie, our Washington correspondent. AMH, let's start there. We talked about it. What campaign? We heard from the president, the former president, over the weekend.
Yeah, he's out there. Two really important states, New Hampshire, South Carolina, Jonathan. But the criticism that's been against the former president within the Republican Party is that this campaign, I guess all before this weekend, was pretty much evaporated, and it really lacks that momentum and excitement that he had in 2016. And this also comes at a time when you see others starting to tee up potential bids that they also want to run in 2024. We've talked about this.
We can think of
Mike
two
Pompeo,
of them. Governor DeSantis down in Florida. Throw in Nikki Haley. Anne-Marie, that's the Republicans, and we can focus on that, but we need to talk about what could be happening on the other side. I thought that we were going to hear from the current president after the holidays about his intentions. What's happened to that?
Well, I think, one, you have the State of the Union coming up next week, February 7th. I also think this president knows that once he throws his name into the ring, while he is still the president, he'll also be viewed as a candidate. Americans much prefer a president rather than a candidate to be president. So he's probably going to wait till after the State of the Union, one, if he does decide to make that announcement. And also, Jonathan, the White House has been dealing with the drip of the documents crisis, whether it was at the president's former office he was using when he was vice president or at his home. That's starting to die down a bit, especially since another former vice president, Mike Pence, there was documents also found in his home. So that is as that's starting to quell and that noise is getting under the control for the White House, potentially then then makes it more of an opportunity for them to come out in the next few weeks.
Anne-Marie, before we pivot, Document Gate, as John was talking about it before, what's behind this? Why is it that so many former officials of the U.S. government have classified documents at their homes? Is there some sort of logical explanation for this?
This is a great question. Clearly, I think you're going to hear a lot of growing calls, and you already have from some members of Congress, to make sure that there is a better procedure logistically in place when officials are leaving their office and they are done with their term in office and they are packing up, that this does not happen. And I think how you have to judge these, or the way we're going to probably hear the Justice Department, was their intent. This is really important when we hear from the special counselors. Was their intent to steal these documents, to take these documents home, or were these accidents? But there's going to be a lot of questions about this, because it's not just the current president, the former president, but it's also now the former vice president. So clearly there's an issue.
When we talk about President Biden and whether he's going to run again and the announcement, there's a long way to go in terms of his actual staff and the overhaul that probably is going to come within the next few months. I think about his chief of staff and the potential for Lael Brainard to take that position as the front runner to take on Brian Deese's role. Is there a sense of who would replace her on the Federal Reserve, and making sure that that was an expedited process so as not to disrupt them?
That is a question that people are asking, but so far there's been no names thrown out as a short list. Partially that is because they are still deciding whether or not it is going to be Lael Brainard to lead the National Economic Council. She is definitely the front runner, but also we're going into an FOMC meeting. There's a blackout period. So until she's announced, you're not going to see any names circulate around on who could potentially take her spot.
Just to be clear, Anne-Marie, Do we have the reporting that suggests she wants this job?
Well, the fact that she is a top contender, I think it makes sense that she probably does want this job, right? I think given where she is at the Fed, if she didn't want it, she probably was in a good position to say, I think it makes sense for me to stay here, especially as we've seen the Fed on this aggressive rate tightening cycle. They're dealing with high inflation. She had, I would say, a very good excuse if she wanted to stay. So I would read those tea leaves as this is something she wants to do.
I don't think this is that controversial, you know, that Lael Brainard's going to this government at all. I don't think it's that controversial at all.
I think it's controversial to see how quickly they're going to replace her, because a lot of people behind closed doors, the conversation is what caused the extra spout of inflation. Well, part of it was the Fed didn't get on the ball early enough to raise rates in the second half of 2021. And part of that was a political reason, because Fed Chair Jay Powell wasn't reconfirmed. And if he had been at that point, that perhaps they would have had more political capital to go ahead with
That's
it.
what some people on the FOMC, former policymakers, have suggested. We don't know, of course.
We have no idea, but this has
sure.
been the speculation. So if you flip that over to now, what kind of potential issue does it cause if the number 2 on the Federal Reserve isn't replaced quickly?
I don't think it changes much for the Fed. I know that people think on the margin it might make it more hawkish because Chairman Powell would have more control. I think Chairman Powell has control anyway. What would be interesting, think about the optics of this. You turn lower in the economy, perhaps you even have recession, and your chief economic advisor to the president going into potentially a race for 2024 and a second term is the former number two from the Federal Reserve, who a lot of people in your own party are blaming for the economic fallout that they're witnessing. I think the optics of that could get tricky.
You mean in terms of President Biden and what that could mean for his reelection? Perhaps, although on the flip side, he could say he got somebody who had the credibility and the knowledge of the internecine workings of the Fed and how it played into the economy. I mean, there are a lot of ways to spin this, but you're right. It creates a complication on both sides. And I do wonder if it already has created that complication regardless of whether she takes the job.
I think you want the brightest minds in government, and that's one of the sharpest minds out there down in Washington, D.C., to take that position. The National Economic Council, I think, for her to put together and really lead the policy effort across government for this White House in this administration, I think that's a big, big issue. I think for this individual, though, just unsurprising when I saw this headline, totally, totally unsurprising. There were reports several years ago about donating to the Clinton campaign. We know that she was the front runner at one point to become the next Treasury Secretary. I'm just not surprised by this at all. And anyone who thinks the FOMC doesn't have political beasts on it, they're out of their mind based on where the nominations have come from year after year, year after year.
I don't think it's surprising, and I don't think it's surprising for her to want this job and for her to take this job and for her to be respected by a lot of people. What I do think that's surprising is the timing, considering just how fraught this moment is for the Fed. We have not seen the full downturn. We haven't seen the unemployment rate materially turn upward. You start to get political interference and the allegations of that. As we head into that period of time, it gets a little more complicated.
You think there are going to be allegations of political interference at the Federal Reserve?
Well, yes, absolutely. You start to wonder on both sides. Either there is not going to be political interference, and they're going to perhaps hike rates more, and then people can push back and say, okay, well, they're just trying to torpedo the party and sort of the current administration. And if they are not hawkish enough, people will say it's because they want to keep the economy humming for the next election cycle. They always say this. I mean, you're laughing, but am I wrong?
I'm laughing because it's ridiculous.
But I know, but am I wrong?
I'm not saying you're right or wrong. I just think the conversation around this Lael Brainard nomination is ridiculous. Anne-Marie, down in D.C.
Stop it then.
AMH, thank you. I just don't think it's that controversial. Don't think it changes much for the Federal Reserve. I think they're all basically on the same page at the moment. How much dissent have you seen from the FOMC over the last few years? How much dissent have you seen over the last few weeks going into this decision? They all seem to be on exactly the same page.
I mean, should I continue talking about it since you think it's ridiculous? But I do think that Lael Brainard, though, has been on the margins more dovish. So that is sort of interesting if her voice gets eliminated and put toward the head of the Economic Council for the administration.
Okay.
Should we end this?
I'm happy to. The clock's almost up anyway. Laura Raim, the chief US economist at FS Investments. I think as journalists, we're always trying to make a story out of something, and I'm not sure how big the story actually is. Maybe many people disagree. I know you do, and others will too. And that's okay.
You know, I think that it's worth questioning because we spent so much time on this issue of could this Fed go through with rate hikes at a time of true economic softening, right? And maybe we'll skip that debate entirely because we'll get this immaculate disinflation. But if we don't, then it becomes a more political question.
I think the data's more important than whether Brainard's on that committee or not.
I think that a lot of people would agree with you.
Futures right now down 0.9% on the S&P 500. Yields a bit higher, up by 5 basis points. 354.95 on a 10-year. Laura Rain of FS Investments coming up.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Equity futures down, lower, negative on the S&P, on the Nasdaq too, going into a monster week for financial markets worldwide. Equities now down 0.9% on the S&P, on the Nasdaq lower by 1.2%. Do you want to chase this or fade this? Saying chase. Steve Cheverone of Federated a little bit earlier this morning on this program saying fade this. Mislav Matejka over at JP Morgan, Mike Wilson at Morgan Stanley. That list is growing in the face of a big rally here today so far in the first month of 23. Get to the bond market. Yields look like this. 2s, 10s and 30s on a 10-year yield higher by 4 basis points. 354.77 on a 2-year. 423.41. Yields up a little bit across the curve at the front end by 3 or 4 basis points also. And just to finish on foreign exchange, I mentioned this a few times, but for those of you still tuning in, waking up potentially stateside, it's very late. Euro dollar 108.99. I wish I could wake up
Not
at
going to scold
7:30.
anyone for waking up at a decent time.
It's very late.
Oh, my.
108.99 on euro dollar. Spanish CPI came in hot. German GDP came in soft. Over the next couple of days, you'll hear from France, Germany, Italy, on their inflation story going into the ECB, Lisa, this Thursday.
So earlier this morning, you know how Ken Tropin of Graham Capital was talking about fading some of the Hang Seng. We seem to be seeing that a little bit in markets today. And I wanted just to point out Alibaba, JD.com, and Trip.com, all of the ADRs of these Chinese companies. And you can see a real market sell-off. Again, this isn't necessarily anything in particular, except perhaps people coming back to the office, seeing the reopening post-Lunar New Year and saying, wait a second, maybe we got a little far. You can see Alibaba shares down 5.3%, JD.com down 4%, and you see TripAdvisor down 2.1%. Then if you flip over into some of the other big winners over the past week, Tesla shares last week surged 33%. A little bit off that froth. We're seeing it down at one point about a 1% decline on the Tesla shares, but now down just 0.6%. Amazon.com ahead of the Thursday report also lower. So again, perhaps people pushing back against some of the enthusiasm. The rally today down 1.2%. And Micron, I'm watching the chip makers quite closely, considering that they've given some pretty negative projections. Those shares dropping a further 1.2%. After the bell today, we get NXP Semiconductors reporting earnings. What is going on there? Is this just an ongoing distortion with inventories built up, or is this something more material with perhaps a misplacement of which chips have been produced and for when, right? I mean, this to me is a real big question in markets.
To your point, Lisa, you said this a few times earlier this morning. The earnings haven't been great, have they?
They haven't been. And so I don't understand people saying, well, if you look at the earnings, that's a reason to rally. Well, is it?
The guidance from Microsoft.
It's been absolutely
the numbers
dreadful.
from Intel.
I mean, honestly, Intel was, some people would say kitchen sink, but other people say there are a lot of kitchen sinks there, and this is a problem.
A lot of kitchen sinks there.
Somebody said that to me.
I mean, it was pretty brutal, wasn't it?
Yeah, it was.
Ugly stuff. Fed meeting on Wednesday, payrolls on Friday. Going into that Fed meeting, Laura Rame of FS Investments saying this: a 25 basis point rate hike is widely expected, of course. I expect the committee to say that further increases are necessary. The battle for rate cut expectations will really heat up, and the Fed will be pushing back hard against the idea that rate cuts are necessary. Laura Rame, the chief US economist at FS Investments, joins us right now. So, Laura, this is the question going into Wednesday in that news conference, if it's not addressed in the statement. Are the recent easing of financial conditions warranted or not? And Laura, I wonder how you think, one, he'll answer that question, and two, whether this market and market participants will actually listen to him.
You know, whether they're warranted is really a reflection of the fact that the markets have been trained, in part by the Fed, to look so far ahead of the curve on the economy that I think they can be too hasty. And in this case, there was so much talk about a recession at the beginning of last year, a recession at the beginning of this year. To me, you know, you really need to look for the timing of this almost a year after the Fed stops raising rates, which is why I've penciled in late 2023 for an economic slowdown. And it means that at earliest, the Fed would really not consider sort of lowering that curve and cutting rates until much later in the year. And for all of those, you sort of paint that macro backdrop, and it means that markets who are pricing in 3 rate cuts this year have just gotten too aggressive. That's pulled down the front end. And look at what we've had. Mortgage refinancings have reignited again. We're about to see the housing market come back to life. The Fed hasn't really broken anything. They have put a pin in all of these interest rate sensitive sectors of the economy. And guess what? When rates come down, those all reflare. And I think that's what the push and pull we're going to see over the next year. And really, it's going to start this Wednesday.
Lots to unpack there, Laura. Can I just pick up on your call that you don't think the weakness comes until year end? Laura, what guides that view?
Okay, you have to take out a microscope to find weakness in the labor market. We've had upsetting headlines in some key industries like the tech sector, but the reality is these are sectors that overhired during the pandemic. They're trying to right-size that right now. And to me, when you look at the broader initial claims, the unemployment rate at 3.5%, JOLTS data, the vacancy rate, I mean, go down the list, Jonathan, pick anything. It is just very difficult to find any signs of outright weakness. Normalization, cooling, all of that is actually healthy. And then on the consumer side, I would argue there's a similar situation. There's been a lot of talk about delinquencies picking up, and consumer banks are being cautious. That is their job. I think at the end of the day, when you saw the earnings from MasterCard, from American Express, the consumer is healthy. With jobs where they are, I think the household can continue to spend, and lower inflation has a role to play in that too. It's not a strong growth picture, it's a grind, but I think it stays positive.
Laura, you said the Fed hasn't broken anything, and then you talk about all these pockets of strength that could keep inflation hotter than the Fed would like. Is the implication here that the Fed has to break something, and then what is it that they have to break?
Well, that's what a recession is at the end of the day. It means that they have taken something and pushed it too far. Our economy doesn't like to contract, so it needs something to be not working right to really fall into contraction. So, they have talked a lot about the labor market. They've talked a lot about wages. And, we need wages to come down pretty significantly. And I'm just not sure that's going to happen given the limited number of job availability. At the end, I think when they think about targeting something to really slow the economy at a broader level, it often is the labor market. But I think right now, they're content with some broader slowing. They just see the need to continue to raise rates. I don't think that's going to change. It's time for them to slow down, no doubt about it. I think they're doing the right thing over the next several meetings.
So a lot of people took some signal from the Bank of Canada, which has been on the front foot when it comes to their moves in their central bank. And they just indicated they're going to go 25 basis points. They went 25 basis points, and they potentially will hold indefinitely. Why is the Fed not going to do that, since it doesn't seem to bother them that much that financial conditions keep easing?
I would push back that it may bother them somewhat. I mean, I think they see it. I think they recognize that when long-term interest rates come down, it undoes some of their rate hike activity. And while I think that they're going to continue to monitor this, I think they recognize that they can't only focus on it because it's not their main mandate. Their mandate is inflation. And until we see it not just hit 2%, but hit inflation persistently at 2%, they have wiggle room to manage expectations, and financial conditions are going to be a big part of that. I think they are going to keep watching financial conditions very closely, especially over the next 6 months.
We're catching up with Jim Bianco of Bianco Research a little bit later this morning. And in his recent note, he said, I think the narrative and attention should now turn to how far down we're going to go, not whether inflation has peaked. Laura, can you speak to that? Are we coming down to 4, or are we going to find it difficult to get down to 2?
Yeah, the inflation numbers are going to look so choppy. This is just because year-on-year base effects are going to make the headline number just really come down very fast. I think, we've now sort of contorted ourselves in the monthly CPI numbers of looking at, services, wages that are excluding shelter. I mean, we've gotten, I think, too micro on the CPI data. We need to step back and we need to include wages in that conversation. We need to include sort of numbers that are in the medium term versus just the near term. Inflation expectations are part of that too, and those have been stickier. So to me, it's really a more holistic inflation picture, and I think the Fed is going to be very focused on more than just one piece of CPI. And the labor dynamics are very critical to that. That's what their medium-term models key off of.
Laura, what are you watching most closely this week in terms of the economic data, the Fed meeting, as well as earnings?
I mean, nothing beats the payroll reports, Lisa. You have to pay a ton of attention to those. So to me, we're really going to end with a bang on that. I think the employment cost index numbers are going to be really important this week as well.
It's fascinating that just a few months ago, there was no space for nuance. Then all of a sudden, the CPI discussion just became really nuanced. Did you notice that with Chairman Powell?
I do wonder how much this is just going back to this feeling that people want to rally. And Chair Powell, I mean, to your point, you think that there's been a big pivot. You think that he has changed his tone
completely. I wouldn't say a big pivot.
Over the past couple of weeks.
I'd say, Lisa, something subtle happened where he went from saying the risk of doing too little outweighed the risk of doing too much. And it seemed that in a couple of months towards the end of the year, that view became a little bit more balanced. I don't think we've had that full pivot yet. I think where there is a massive spread at the moment, and you appreciate this, and Lara does too, is between where the Fed is saying what it will do this year, which is a second phase of their effort to tame inflation, is just to keep rates unchanged against the backdrop of disinflation. That means you stay tighter than this market thinks, and this market's looking at rate cuts. And if we reconcile that spread with the market coming up to the Fed, that's going to come with some rate volatility. And if we get that rate vol climate again, then we've got a problem for risk assets too.
You know what no one's ever talking about anymore?
What's that?
The balance sheet roll-off.
I know, QT.
Why is nobody talking about that? It's actually happening. I mean, not that fast, but, you know, we've seen $500 billion taken down from the balance sheet, and it's going to keep going and keep grinding and keep accelerating on that front. So even if Fed keeps rates at 4.5% to 5%, it's going to be an ongoing tightening. Why is nobody talking about that?
Because it's like watching paint dry. That's what they want it to be. It's not, of course, at all.
Maybe it is, because nobody's talking about it.
I agree with you.
But I just, you know, where does that come into play? Because there's so much money in the system still, and everybody has money, and let's spend money, and as soon as people want to feel risky, they can go into whatever they want because they've got the money. Well, what happens when it gets drained from the system a little bit more?
At least they got what they wanted on that front. They wanted it to be like paint drying, and to your point, no one's discussing it. Maybe they should be. It doesn't really come up in the presser either.
It never comes up.
Not at all.
Is it paint drying? I don't know. I don't think it is, but Lisa, I was so wrong on the ECB. Getting to 250 without there being real damage in the bond market. At least when I say real damage, I thought it'd be monster damage in the peripheral bond market. I was wrong about that. So maybe QT is like paint drying for this Federal Reserve. I don't know. It's not to me, it's not to you, but that's not really what counts, is it? No, but that's the market seems to be saying. We like watching paint dry. It's nice.
Did I say thanks to Laura? I'm not sure I did.
Thank you, Laura.
Thank you, Laura. It's a bit late. I'm sure she's gone.
She's like, goodbye.
Those guys talking about QT. John and Rochester of Nomura joins us next on this FX market. That's next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden will meet with House Speaker Kevin McCarthy Wednesday to discuss raising the debt ceiling and avoiding a U.S. default. Republicans want a deal that includes government spending cuts. The president has refused to negotiate over the debt limit. In Germany, the economy shrank 0.2% at the end of last year. That was worse than expected, and it makes a recession more likely after all. Soaring inflation, in part due to higher energy bills, has weighed on German household spending. Billionaire Gautam Adani attempts to restore confidence in his business empire. Well, that's falling flat with investors. Shares of most Adani Group firms slumped again today. The sell-off has now erased about $68 billion in market value. Over the weekend, Adani issued a 413-page rebuttal to allegations of fraud by short seller Hindenburg Research. Toyota is the world's largest automaker for the third year in a row. The Japanese company's sales were mostly flat at 10.5 million units for the year. Meanwhile, Volkswagen sales, they fell 7% to 8.3 million units, its lowest level of deliveries in 11 years. And Bloomberg's learned that the Chinese search giant Baidu will roll out an artificial intelligence chatbot similar to OpenAI's ChatGPT. The tool will allow users to get conversation-style search results. It's set to debut in March. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
that the dollar could come under a little bit of pressure. The Bank of Japan as well is starting to adjust its YCC. So I think the dollar is definitely peaked. I don't see a precipitous decline, but a gradual decline as other central banks catch up on the policy front.
Subhadra Rajappa there of SocGen. Always wonderful to hear from her on this bond market and on central banks too. Central bank decisions are plenty this week. The Federal Reserve Wednesday, the BOE, the Bank of England and the ECB coming up on Thursday. Going into all of that, some earnings and a splash of economic data. Equities are lower this morning. We're down by 8 or 9/10% on the S&P. What's wrong with you?
It sounds like a cooking channel.
I know. It's a recipe for uncertainty.
Oh, that's good.
And lower markets.
I like that.
And higher bond yields by 4 basis points, 354.77. That's how the table is set going into the Federal Reserve decision. Have you ever heard this quote? Hard times create strong men create good times create weak men create hard times.
You just read it to me. Yeah, I like it.
Okay. Now listen to this one. Just got sent this. This is brilliant. Low interest rates create weak men. Weak men create high interest rates. There's a picture of Chairman Powell there on that one.
Oh, boy.
High interest rates create strong men, and strong men create low interest rates. There's a picture of Volcker at the end. What do you make of that?
You want me to take it seriously? Because I actually think it's great.
There's a regime story in there.
There's a regime story. There is a story of men, great and small. No, honestly, I mean, it's easy to have a business model with free money. It is harder to have a business model with expensive money, and that is perhaps what we're seeing. I don't know if we can talk about strong men versus weak men.
We're very inclusive here. People. You can
People.
replace the word men with people. Highly, highly inclusive stuff. Equities down on the S&P by 0.8%. Yields up by 4 basis points on a 10-year at 354. Euro dollar just back through 109. CPI in Spain hot. GDP in Germany soft. Going into more inflation reads and an ECB decision on Thursday, and a stronger euro and all this optimism, constructive stuff about the future of Europe relative to the doom and gloom and less constructive stuff over the last 12 months. Jordan Rochester joins us now, G10 FX strategist over at Nomura. Jordan, great to catch up with you, sir. So it is conference season, which means you leave London, you go around Europe and you try and pitch your ideas. And Jordan, I just wonder how many people are on board with this constructive Europe, long euro story from the people you speak to?
Well, we've been around the world recently, and I've had probably one client that's pushed back a lot on the euro view, mostly from a positioning angle as well. So when it comes to positioning data, and also just the proxies, CTA positions, momentum, all of those sort of ways we can judge how overexposed investors are to this long euro short dollar trade. That is the problem. Everybody seems to agree. So now we're entering into a world of how can things go wrong? And the GDP numbers from Sweden stand out this morning, coming in weak, as well as Germany. Maybe the optimism in the surveys that we've seen in the past month are just a flash in the pan. I don't think it is a flash in the pan. I think there are key reasons why euro can go higher, but it is now the case that it is a consensus view. So my job now is to keep an eye out for how things can go wrong.
How much is the divergence in central bank momentum or direction really the only driver here between what we're seeing with euro going higher and dollar going weaker?
Well, I think the FX component to rates, that correlation, it's the bread and butter of foreign exchange. If you had an ECB view that was strong, and if you had a Fed view that was strong, you could express it in both rates and FX, and they were highly correlated to each other. It's not the case anymore. Rates do their own thing. FX does another. The balance of flows are trade dominated and fixed income dominated, as well as equities. So it really depends on where you see those flows going. The most consistent factor to follow is growth. So if you think growth's improving, the dollar will weaken. Global growth, that is. So in this environment we're currently in, with energy prices lower, with fiscal stimulus in Europe, with the potential reopening in China, it's all positive for European growth, and there's a big momentum change to what we had last year. So in that environment, euro area growth could outperform the US, or at least from where we were in terms of pricing. So in that environment, I see euro dollar going towards 110 very quickly. I know we're nearly there. I had it as my target by the end of day tomorrow. That might be a little bit too much in just one day, but we're looking for 113 in Q2 and 116 by year end.
Jordan, you said potentially reopening in China. What do you have to see there for the euro to go higher?
Well, China is reopening, but we have to take it in the stages. Right now, we're still coming out of the situation over the winter, which was high levels of COVID cases, and confidence in China still being rocked around. There's also how long the feed-through is to growth data. We could still see weak China data for the next few months, and we don't see the rebound perhaps until the second half of this year, the material rebound. I'm optimistic that the spring weather, so from end of March onwards, April, May, we could really see a rebound in China's reopening and Hopefully we see some fresh fiscal stimulus, who knows? That could really accelerate the story. So that's why I think the big move in the euro higher could come in Q2 as we go into that warmer weather. And then it slows down towards the end of this year.
So you think that Europe imports a stronger growth impulse? Does it import the inflation story too?
This is where Europe stands out, and I think the Spanish data was really interesting this morning. So all my leading indicators for euro area inflation and the US, they're collapsing. They suggest disinflation, expect lower prices. Then you get Spain, and Spain leads euro area inflation by 2 months because they're more exposed to energy prices with floating contracts. And it came in hot today, and I didn't expect that. Most economists thought we'd have a big slowdown. So it could be the case, I think, John, that US inflation continues to really slow down. I think we could have goods deflation in Q2. We already are having signs of that anyway. Where in Europe, because of the big fiscal stimulus, 7% of German GDP, this could lead to a sort of difference in inflation, where inflation rebounds in the second half of this year in Europe, whilst the US is slowing down. So we do have the ECB hiking rates all the way to 3.5% and then keeping them on hold for the rest of this year. Very different story for the US. We have them raising rates until the end of March and then cutting rates towards Q4. So that story could see the euro outperform just because of a hotter inflation environment. And the big part is thanks to the fiscal stimulus, but also the bigger exposure to China. Germany's 3 times more exposed to China via trade than the US.
Jordan, just to build on that, you clearly think that is a euro strength story based on your projections as implied by the fact you think the euro dollar gets out to 116 near year end. Jordan, what's the risk that actually ends up being a euro weakness story?
The main factor is if we flick from the dollar smile, which we're currently in, which is things are good elsewhere, therefore the dollar weakens. If we were to flick not towards US growth outperformance, because I really don't see that happening. You haven't got any fiscal stimulus coming this year. Republicans with the House will make it very difficult to even get the debt limit ceiling raised. But we could have the other side of the dollar smile, which is big risk off, credit spreads widen, European assets underperform. Very possible, but that's a grey swan. It's a black swan. You can kind of hope for the best, prepare for the worst. So if we did see that credit spread widening, a lot of people would be quick to get out these euro-dollar longs but we just don't know what that is. We're just kind of just waiting around. What I will say, John, is the good news is the EU have been very good at playing a game of whack-a-mole. All of last year, they were very good at dealing with any problem that came up. The EU provided loans or assistance or fiscal stimulus. This time round, because we're still with Russia and Ukraine at war, I think the EU will be quick to help out with any credit stress like this, unlike the US, where Joe Biden's hands might be more tied by Congress.
Jordan, just quickly, wouldn't the greatest word to use for Europe right now just be stagflation? And why aren't people using it?
Oh, we used it a lot last year. Stagflation was everything. Growth, lower, higher inflation. This story now is disinflation, potential deflation, especially in the US. But disinflation, so inflation coming off the very high levels, base effects helping, but also we're seeing signs that firms are charging less ahead. So that's kind of, it's actually good for your real GDP forecast. You can lower your inflation forecasts, whilst growth in the euro area has been very weak last year. We've had very, very early signs in the January data of a bounce back, and I really hope that carries on in February. If that bounce back happens, it's not the word to use, stagflation, it's a growth recovery. Revise up your real GDP forecasts.
Okay, we'll see. Jordan Rochester of Nomura on the latest on the FX market. Thank you, sir. I mentioned this because if I told you 2 years ago that we had 0% GDP growth in Germany and inflation pushing double figures, I think you'd have a word for that.
Yeah.
And that word's not being used.
Well, no, because it's negative and people are sick of it. I think that people are just sick of the narrative of last year, so they're trying to change it for this year. So it's lots of growth, even though you're not really seeing growth and in Europe, and it's disinflation in the US or outright deflation. You know, to some degree, it's because there are signs of growth in a new way in Europe that we haven't seen for a little bit in terms of China reopening. Like that's actually truly giving some increase in demand. It could change things, particularly in the auto industry, particularly in Germany, but you're not seeing it yet, to your point. So, you know, at what point do people just start calling it what it is?
Well, it is exactly what it is, right? And we've got stagnation. We haven't got recession, I get that. We've got stagnation, though, and we've got inflation, which is close to double digits, and you can make the argument that maybe that's going to change in the next 12 months, but just trying to make an assessment on where we are right now.
But often it's the direction, right? Stagflation means that it's stagnant, that there's not necessarily a direction that it's moving in. And a lot of people are seeing the prospect, particularly with fiscal stimulus in Europe and China coming back online, that it's not going to stay this way. To your point of, are we going to see people actually go long?
I'm starting to sound like you.
I know. Like, what is this?
I've got no idea.
I mean, this
I've
is
missed you, though.
ridiculous.
It's been 2 weeks. I haven't sat with you for
really
ages.
Nice.
So there you go. Equity futures down 8 or 9/10 of 1%. Very Bramo-esque. Stagflation, Europe, all that gloom.
I'm fighting against it.
All that stuff. Yields up 4 basis points, 354.58. Coming up next, Tony Rodriguez.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's Renewable Assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The recession that people feared 6 months ago is not happening.
There's a decent amount of momentum going into the fourth quarter.
If you look at equities, we're sort of middle of the road.
The key thing, I think, for corporate profitability, the outlook for earnings, is really nominal money.
The thing I think would be destabilizing, volatility inducing, would be if it looks like inflation is going to get stuck.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The Fed decision on Wednesday, payrolls on Friday. some central bank decisions and earnings in between. Is that enough for you? Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Brabbitts, I'm Jonathan Ferro. Equity futures right now down 0.9% on the S&P. Really bucking the trend of the year so far. What a month of gains we've seen, Bramo, taking place.
Led by the sector that was evidently dead and never going to reassert its leadership over the index, which was big tech, which has reasserted its leadership. And a lot of people are going all in. How long can that last, considering all of the negatives that people had, all those arguments that seem to not be applicable anymore?
Over to you, Chairman Powell. Chairman Powell, we all have one question. The easing of financial conditions, warranted or unwarranted? How do you plead?
Do they care, right? I mean, because basically you're seeing the market move in an opposite direction to what they ostensibly would want, unless there's enough weakness to give them confident that they're still moving in this sort of immaculate disinflation. And I still call it immaculate disinflation because this whole question of a soft landing is unheard of in a tightening cycle. Sure. So is this time different?
You've been on top of this story, and I want to build on it too. It's not just about how he answers that question. It's how market participants choose to respond to that response to that question. Because over the last couple of months or so, I have to say, the chairman's spoken. They've all spoken. They've all said we're not cutting anytime soon, and this market's still pricing in cuts.
They keep pricing in cuts, even as Fed officials come out and say, we're going to 5, we're going to 5.25. Potentially the upside risk is still there. And people shrug it off because they say, look at the data. It's in our favor. And so at a certain point, you have to see the data. But which data? That's my issue. Because if you start to see jobs that come in much stronger than people expect on Friday, is that going to be the key data point for this week?
Perhaps that's an important question too. With that in mind, what's more important, the Fed decision on Wednesday or the data that we get through the rest of this week and into Friday?
I would guess the data, and specifically, I mean, I'm just going to piggyback on what Lara Rayam was talking about, this question of the cost index, the employment cost index, and how much the price of employees is going up. People are demanding higher wages. Is that going to give the Fed some pause, especially with JOLTS coming out on Wednesday?
The bias is pretty clear, isn't it? That most people just assume inflation is going to come down, and really the question is, how does the Fed respond to that? The market says cuts, the Fed says no, we're going to hold, and we're going to see this through. The big risk going through the rest of this year is what happens if inflation is far, far stickier than people expect. Andrew Balls of PIMCO joined us last week, and he talked about that. He didn't say it was his base case, but it's certainly a risk. And we're hearing that from Andrew Hollenhorst of Citi. Citi really believes that there is a hawkish surprise in store here from this Federal Reserve. Perhaps not at this meeting, maybe in March. And ultimately it comes down to this view, and here's the quote: we expect upcoming stronger core inflation to challenge this most recent version of the transitory inflation narrative. I think the quote of the last couple of months on this program was Sarah House of Wells Fargo, when she came on and talked about the final mile. And she said, the final mile, when you get down to 4, then give me the then what? How difficult will it be to get from 4 back down to 2?
I'll give you an anecdote. The housing market, the first rate-sensitive sector that everyone was looking at as a possible area of collapse or at least a significant downturn. We've seen it start to rebound. We've started to see it actually stabilize in terms of home sales not posting that big of a decline, considering that home prices have actually climbed slightly. The fact that you're starting to see people refinance their mortgage rates as they come down. I mean, honestly, there's so many points that really suggest you can't kill this beast that quickly.
Lots of people writing in this morning, including Barry Knapp of Ironsides. On the Bloomberg, he says, payrolls over the presser. The payrolls report more important than the presser. I'll ask that question through this week for you, going into payrolls and the presser later this week. Payrolls on Friday, the press conference, and Fed Chair Jay Powell at his delivery on Wednesday. Equities right now down 0.9% on the S&P, the S&P 500 and the Nasdaq a whole lot lighter, lower, negative, down to kick off the trading week. In the bond market, yields a bit higher by 4 or 5 basis points on a 10-year, 354.95. In Europe, it's all about the ECB on Thursday and the data between now and then. Inflation in Spain came in hot, GDP in Germany came in soft, and you'll get its CPI reads from France, Germany and Italy over the next couple of days, Lisa.
So somebody wrote in regarding Europe and our discussion on stagflation. If this stagflation isn't stagnant, is it transitory? I think that everyone's getting a little exhausted. Everyone's a little exhausted from all of these catchphrases.
No, I think I need a few hours sleep to get my head around that. Tony Rodriguez joins us now, the head of fixed income strategy at Nuveen. Tony, can we start with that question? What's more important to you this week? Is it the news conference with Chairman Powell on Wednesday or the payrolls report on Friday?
Well, good morning, Jonathan. Good to be with you. And for us, clearly, the answer is the data in the employment report. We think that the press conference, we certainly expect Fed Powell to be relatively hawkish in terms of his pressure. The idea for him is that there's no upside really to turning dovish at this point. Financial conditions are easing. The market's moving in that direction. He wants to push back on that a little bit. So I don't expect that to be a very eventful Fed meeting or press conference. But when we look at the data, there I think is quite a substantial amount of possibility for a surprise to the market in either direction. We think that the consensus is going to be, in the ballpark accurate. So we think some of the trends that we're seeing right now, both with respect to the data and on the economy and the data on inflation, are likely to continue here over the next couple of months.
So how do you push back against people who are starting to say that it's a little too neat for the 10-year yield to continue to decline through this year, and for people to get confidence that the Fed both has control over inflation but also won't crush this economy?
Yeah, you bring up a very good point, Lisa. I mean, right now we think that the rate story is probably about right. We think rates will be range bound here until later in the second half of the year. And then we'll begin to price in some of the economic weakness and slowdown that we're expecting. So we're forecasting the 10-year maybe ends the year at 3.25, not far from here, but the direction continues to be lower. Where we think there's a little bit of a disconnect is that we think there'll be some economic slowing. We think that'll cause the Fed to certainly pause, but our view is that 23 is the year of the pause and not the pivot. So we wouldn't be expecting any cuts until 24. And when you put those two things together, it means that the returns you've seen so far in January and since October, you don't want to be annualizing those. We think that there will be some reversal here and some give back in terms of the very strong start that we've had to the year as risk assets kind of reprice to a little bit less rosy scenario.
Rehearsal. Does this mean that you're selling investment grade and high yield bonds?
No, we're not selling here. We're definitely focusing on the higher quality segment of the high yield bond market, the emerging markets of leveraged loans. So we don't want to dip down into lower quality because we do think there's still some risk here as we move through the next couple of months. And we want to have some powder dry. So we would be expecting to increase our risk exposure over the next, call it 1 to 4 months, because we do think we'll see some repricing, a little bit of weakness, a little bit of spread widening. So those better entry points, you want to have some powder dry to take advantage of them.
Tony, what do you make of the spread tightening we've seen in high yield? With the data where it is, the PMI's sub 50, the default rate arguably this year, coming from a very low base, granted, but moving in the wrong direction. Expectations that unemployment is going to be higher, not lower. What do you make of the spread tightening we've seen in the face of all of that?
Yeah, so Jonathan, if we go back to where we were, say, in October, we think the direction of tighter than where we were at that point makes sense. The data has certainly been more resilient. When you think about the macroeconomic data, the inflation data has certainly been better. When you think about the expectations for Europe, those have been substantially better because we were hoping for a warm winter, but we hadn't had it yet. And of course, the China reopening, the regulatory crackdown easing, that's all been better news. So I think the direction is correct, but I think it's just gone a little bit too far. So right now we're talking about a high yield market is pricing in an implied default rate of around 2.7, 2.8%. We think it's moving above 3%, but it's not going to be to a level that becomes really disruptive for the financial markets. So again, our view is that there needs to be a little bit of a backup here and repricing because it's gone maybe a little bit too far. But the broad direction is pricing in some of the better news on both inflation and growth that we're expecting to be really continue over the first half of the year.
So, Lisa, you take the wides from, say, the end of September, not the ultimate wides of last year, but wide enough through 550. I think we're about 150 basis points south of where we were at the end of Q3, the start of Q4.
Yeah, if you take a look at it, since June of last year, the spread was about 6 percentage points over benchmark rates for high yield bonds. Now it's 4. Just to give you a sense of the direction of travel. Can we get an economic cycle without the default cycle? That's really what I'm asking. Without unemployment going up. With inflation coming off.
So what exactly is going wrong?
It's just, distortions that have been righted. I mean, that's what a lot of people seem to be stealthily believing, underpinning a lot of these trades.
Just ultimate surgery. We just take out the distortions and there's no collateral damage.
Well, I mean, is that what we're pricing in?
The immaculate disinflation, your favorite phrase.
Well, I think that seems to be... I mean, I'd ask Tony this, right? Is that basically what's being...
You've got enough time to ask
Tony, is that what we're pricing in here? The immaculate disinflation with just surgical removal, to quote John, of the distortions?
Well, like I said before, I do think that we've gotten a little bit ahead of ourselves here in terms of market pricing. If you had talked to us back in November, I think I would have said that the possibility of a soft landing was maybe 30%, 70% was a kind of mild recession. But as we sit here today, because things have moved in the right direction, I'd say that's a bit more balanced, more of a 50-50, that the Fed is possibly able to achieve it. So markets are certainly should be pricing in better levels today than we were back in October. It's just that right now, the pricing in of cuts in the second half, again, looking at what the returns were in January and thinking you might be able to annualize that kind of return, that to us is way too optimistic. It's going to be a little bit longer period for this economy to bring inflation back down close to the Fed's target. We don't see that till the end of 24. So we do think that, what you saw in the GDP about final sales to domestic purchase around a 1% type of growth level, that to us makes a lot of sense, that we're going to be sitting here in a 0 to 1% growth environment in 23. So that is not one where you should be pricing in, high yield at a 2.5 to 3% default rate. You need to price in closer to 3.5 to 4%, but you don't need to price in a great financial crisis level of defaults.
Hey, Tony, this was great. It's good to catch up. Tony Rodriguez there of Nuveen, looking ahead to the week ahead and ultimately suggesting that for him at least, what is most important to him is the data at the end of the week and maybe not what Fed Chair Jay Powell has got to say on Wednesday. Coming up on the earnings, Tom Forte, the senior research analyst at D.A. Davidson. We've got Apple, Meta, Google, Amazon, all coming up this week. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Iran, authorities say that a drone attack caused a heavy explosion at a Defense Ministry ammunition depot. The attack happened in the city of Isfahan. According to the Wall Street Journal, Israel carried out that strike. The journal says the aim was to look for new ways to contain Tehran's nuclear and military ambitions. In the UK, Prime Minister Rishi Sunak says he cannot raise taxes to fund pay hikes for workers in the state-run National Health Services. Sunak told an audience of healthcare workers that, quote, nothing would give me more pleasure than to wave a magic wand and have you paid lots more. Nurses and ambulance workers are both planning strikes on February 6th. The Federal Reserve is set to shrink interest rate hikes again this week. Policymakers are likely to raise their benchmark federal funds rate by 0.25 percentage point on Wednesday. That would follow recent data suggesting the Fed's aggressive campaign to slow inflation is working. The CEO of TikTok will testify before a House committee on the company's privacy policies and its relationship with China's Communist Party. That hearing is set for March 23rd. It will be Shou Zichu's first appearance on Capitol Hill. FBI Director Christopher Wray has said China's government could use TikTok to control millions of users' data or software. And Boeing predicts China will jumpstart global air travel this year. The jetmaker says the reopening of China's borders will boost travel almost to all pre-COVID levels. Now, a Boeing executive reiterated the company's forecast that airlines will need another 41,000 planes over the next 20 years, with China as a key buyer. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
Pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
If you look at equities, we're sort of middle of the road, but think about the opportunities, the valuations that really needed to come down. It's in software, it's in tech, it's in venture, and we have started to see a pretty meaningful reset there.
Was Anastasia Amoroso of iCapital, Chief Investment Strategist, live from New York, looking ahead to the Fed decision on Wednesday, payrolls on Friday, and some earnings and some economic data in between. Equity futures down this morning, this Monday, to kick off the trading week. We're down by 0.8% on the S&P. The Nasdaq even lower, yields a bit higher by 5 basis points, 355.51, and euro dollar 109.03, positive 0.33%. Spanish CPI to kick off the week coming in hot. The ECB set to hike 50 basis points on Thursday, after most people expect the Federal Reserve will go just 25 basis points on Wednesday. Joining us now to talk about the earnings, Tom Forte, the Senior Research Analyst at D.A. Davidson. Now, Tom, I have some sympathy for you, sir, because the earnings calendar for big tech, the big names in the space of, 48 hours. Now, Tom, I won't ask you to pick your favorite baby, but if you had to pick one earnings report right now that I could give to you, Tom, what would it be?
So if I had to see an earnings report right now, the one that I want to see is Amazon. So I'm curious, the term I think that you're going to see this quarter is beat and layoff. So to what extent are these big technology companies laying off employees, but still outperforming against expectations? So I think that these layoffs put these companies in a position where it's more difficult for them to show better than expected sales and profits. Because if they had better than expected sales and profits, why are they cutting headcount so significantly?
It's a really important question, Tom. So let's ask the question as to why Apple isn't cutting headcount.
So Apple will cut headcount. They'll do it in one of two ways. If you look back to Amazon, between the first quarter and second quarter of last year, they cut about 100,000 heads, mostly at the fulfillment center level, when they acknowledged that they were overbuilt for the current level of demand. So Apple could cut by attrition, much like Amazon did. They've been one of the companies who's been in the news for wanting their employees to return to the headquarters, return to office for a greater period of time. They could assist on that and then have some attrition there. They could also lay off their employees at the retail level. So I do believe that Apple, while they haven't done so yet, like everyone else, they will adjust their headcount for the current level of demand.
So far this year, Tom, any kinds of announcements of layoffs has been met usually with a rally in the shares of the company, with this feeling of cost cutting that would allow growth to continue to accelerate. At what point is that not true anymore for the tech complex?
So the question is, are they cutting fat or are they cutting muscle? And I think to some degree, a lot of the cuts have been fat. These companies were bloated in terms of headcount, especially bloated given the low level of demand for e-commerce today and for digital advertising. So the question is, at some point, are they cutting muscle and not fat? That remains to be seen. But I think that the reason you're seeing the stocks react favorably to the headcount moves is on the expectation that on a near-term basis, it'll result in higher margins on lower expenses.
There are a couple different strains of ideas for the economy within these tech earnings. There's a business side, particularly with cloud computing and the spending that you've seen, or not, with a disappointing outlook from Microsoft, which potentially we might see repeated by Amazon's AWS. And then there's the consumer side, the consumer still buying and Apple continuing to be strong on that level. Which prong do you think has the greatest weakness? Are we seeing some of the bigger softening?
Yeah, the greater concern, and this pertains to Amazon, from their third quarter results wasn't that their mature e-commerce business was slow growing, it's that their faster, higher margin units, cloud computing and advertising, were starting to feel the negative impacts of an increasingly challenged macroeconomic environment. So to the extent we see more signs of that when Amazon reports, I think that's the greater concern, given that it's higher revenue, higher margin for Amazon.
Let's build on that, Tom. Barron's wrote about this weekend. I think it's the question to ask for these tech names right now. Are we seeing some of these names face just a little bit of a cyclical test? Or are we seeing some of the structural story that's dominated these names and delivered monster gains over the last 5 years or so? Are we seeing that structural shift, a change in the underlying trend, Tom, that could be with us for years to come, regardless of the cycle?
I'll go with the structural shift. I think that gone are the days where you can get up and expect Amazon, Apple, Alphabet, Meta platforms to outperform against NASDAQ automatically. I think you need to see some company-specific initiatives, or in the case of Alphabet and Meta, a rebound in digital advertising on a strengthening economy for those shares to outperform the NASDAQ even over short periods of time. So I would say it's more structural. I think it's a change in dynamics, and I think it's something that's going to continue to play out over the next 12 months.
Tom, how does that influence your thoughts on how we should be thinking about valuing these companies with that in mind?
Well, the challenge for Amazon long-term is, in order to maintain its premium multiple, they essentially have to outgrow the contraction in their multiple from an earnings standpoint, which is why you're seeing such a significant shift in focus to services, to higher margin efforts for Amazon. But the question for all these companies in big tech is, can they outpace the contraction in their multiple, perhaps by having their profits grow at a higher than expected rate? And I think it's going to be a challenge across the board.
What's going to happen to the unprofitable tech companies? And I think about Snap, for example, as they report earnings tomorrow. Is this going to be the beginning of the end?
All right, so two things. One, the good news is that you're seeing a bid. So a lot of the companies this year are getting positive performance in their share price, even if you're seeing a pullback in some of their projections for earnings. But for the companies like Snapchat, for companies that are losing money today and maybe don't have a great balance sheet, they're basically in a race against time. Can they get incremental capital? Will the capital markets reopen before they run out of money? And in many instances, it's to be determined.
Hey, Tom, this was great. Hopefully we can do this again later this week when these numbers start to drop. Tom Forder there of D.A. Davidson. What have we got? Apple, Amazon, Meta.
Yeah.
What else have we got? Alphabet.
Just and we've got Snap tomorrow. It's
ridiculous
a nightmare.
Lineup.
I mean, honestly, can you imagine having to analyze all of these companies as they come out? We asked Tom beforehand, is this exciting or a nightmare? And he just said without pause, nightmare.
I heard that from the analyst on the banks who will report it before the long weekend. I can tell you Apple, for those interested, February 2nd, a little bit later this week. Big week coming up.
Thursday.
Have I said that enough this morning?
I think you should say it a little bit more. I think
big week coming up.
Good. I think now people understand. These are going to be some of the more interesting reports, earnings reports. And I think that what Tom Forte just said there about the macro play, you get both the business pullback and you get the consumer spending, both converging in the likes of Amazon, and how much you start to see that weakness. Could that play in a bigger way? Could that be a sort of economic data point in its own right?
Is TK coming back tomorrow?
So I hear, and this is going to be the first time in a couple of weeks that we've all been together. I think people think we are on a boycott of being together.
A boycott of what? Of being together?
Yeah,
Why
and that's not true. I don't know. I've been getting a lot of messages.
What are they saying?
What's going on? Why are the three of you never together?
What's the conspiracy theory?
Somebody was like, the honeymoon period is over.
There was a honeymoon?
That's exactly what I was thinking. Like, at what point did someone think this was a honeymoon? But on the other hand, he's just off today, and he'll be back tomorrow, supposedly, for the Snap earnings. That's really his key.
That's exactly what he's coming in for. Yeah, he loves that.
He loves that.
I can picture his face.
Yeah, he's going to be all about that. And Apple, he's going to be holding up his iPhone the entire day.
Well, that's usually what he does when they cover the name. Companies adapt, didn't you know?
They also adjust.
They adjust and they adapt.
So we hear.
Tom's line on corporate America. I mean, it's true, though. In the next hour, we'll catch up with George Concavos of MUFG, Kristen Bidley of Citigroup, and Jim Bianco of Bianco Research, looking ahead to a monster week of earnings, of central bank decisions, and of economic data as well. We've asked the question through this morning, the most important one for Fed Chair Jay Powell, the easing of financial conditions over the last few months. Is it warranted or unwarranted? And once you've got the response to that question, how do you respond as a market participant? Do you ignore Chairman Powell and focus on the rate cuts that perhaps you're pricing? We've had that question asked repeatedly through this morning. And when I asked the question, are you focused on the data or Chairman Powell, what's the response we're getting?
Data.
The
hands
data.
down.
And what does that tell you about how they're going to respond to Chairman Powell on Wednesday?
Well, I'll tell you this. A viewer writes in, ChatGPT says Bloomberg morning guests are at odds, citing egos.
Is that
so
right?
That's what ChatGPT says. We will see, but data has ruled out.
I mean, I'm tempted to ask. Dare I ask who you think's got the biggest ego on this lineup?
With what, guests? Or just the show?
Just in general.
In
on this
general?
show. On this show, just in general. How would you rank?
Wow, God, look at those markets.
Look
They're
at
really
them.
going down.
I gotta go. I gotta go.
Seeds, typically between the time you start and they get out in the farmers' fields is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Welcome back. This is Bloomberg Surveillance on TV and radio. It has been an amazing year for equities, particularly big tech. Until today, we are seeing that softness kind of bleed in with the S&P down about 0.75%, just basically hanging in there, 40.53. Yields just marginally higher, 5 basis points to 3.55%. But really, the stasis in that area has been remarkable. A bit of euro strength, 108.96. We were talking with Jordan Rochester earlier this morning of Nomura, talking about the potential for 113 or even 116 euro versus the dollar by the end of this year. Just an ongoing strengthening in the face of of some better than expected outcomes with respect to weather and China and crude. A little softer, but I have been watching crude and wondering at what point we've priced in the reopening of China. We've been talking about that throughout the morning. A massive week, as we've been saying, throughout the morning in terms of tech earnings, in terms of the FOMC meeting and the decision on Wednesday, in terms of the payrolls report. And there's been a big question of what people might not be seeing. Are people going to keep pushing back against the Fed and say that the data is showing disinflation, whether you want to call it immaculate or otherwise? Michael Gapin joining us now, head of U.S. economics at Bank of America Securities, doing his best Sean Farrow impression, sitting in his chair. I am curious, Michael, whether you think that you're going to end up with a big pushback this week from Fed Chair Jay Powell, regardless of what he says, with people going about their business and continuing with the disinflation kind of trade.
Big pushback? Probably no, right? I mean, the big pushback is what's more important, what you do today or what you say you're going to do tomorrow? And if they're slowing down to a pace of 25, it's hard to, I think, push back too strongly. So, I mean, I think that they will reinforce their message and repeat their message, but I think it's hard to be hawkish and strong when you just slow down again. So the policy action suggests they're more comfortable with the outlook, they're more comfortable with where they are. Pushing back, and at that point by saying, no, we're going to be super hawkish, it's hard to do that.
So I remember a long 6 months ago when people were really talking about the potential pain, including Jay Powell, to markets, to the economy, if you have both rate hikes as well as a balance sheet runoff. We're talking about rate hikes and how perhaps we're at the penultimate peak of them, or whatever you want to call it, if you're Stephen Major over HSBC, but no one's talking about the balance sheet anymore. Should we be?
I think we're going to get to that point. So if the Fed is in a higher for longer phase, right, and they're saying, okay, markets expect more rapid disinflation, they're looking for cuts, fine. It's a different view of the outlook. We think inflation is going to be stickier. And you heard Governor Waller say, hey, we should consider continuing to run the balance sheet off even as we cut rates, right? I don't think that would be consensus. Like we and others, I think, are saying if the Fed eventually cuts rates, they probably stop QT at the same time. And I think Waller kind of threw out there for the first time, you know, maybe not. Maybe we run the balance sheet off for longer. So you get more combined tightness out of the funds rate and the balance sheet.
Have we seen it yet, the tightening from that particular effort?
Yes. I mean, the markets build all of that in advance, right? I think if you're a stock person versus a flow person, you think, well, how much total cumulative runoff of the balance sheet are we going to have? Therefore, how much our market's going to have to absorb in Treasury debt? This would be a way of saying, hey, maybe you didn't think the balance sheet was going to run off as much as you thought, right? So you might get you reevaluate your expectation of just how much Treasury debt the market's going to have to reabsorb.
Another way of asking this is, when do we start to see the peak influence of the tightening cycle in economic data? Have we already started to see most of it or a material amount of it, or will we only see it 6 months from now?
I think we're literally just getting to the point where we're seeing it. I think that historically, and the modeling would tell you it takes at least 12, if not 18, maybe even up to 24 months to see the cumulative effects of tightening come through. So conditions started to tighten in March and April of last year. We're in the first quarter again. So I think it's really still in front of us. So I think there's more to come. And I think that's why most of our growth expectations for 2023, soft landing versus hard landing, are still weaker than they were in 22.
When it comes to the labor market, we get the labor market report, the non-farm payrolls on Friday. What do we have to see in order to continue with this feeling that the Fed is making progress? And I put progress in quotes because nobody wants to see progress as people losing their jobs, but really making some inroads in terms of softening the economy enough to bring inflation down.
I mean, I think the target here from the Fed's perspective is monthly job gains 70 to 100,000 or less. So what I think you would need to see Friday is we're on a path to that, and to get there in the next, say, 3 to 6 months. We're likely to get some payback from the California strike this week. We think the headline will be around 225, so similar to what we saw last month. I'm not quite convinced that we'll get that message this Friday. But that I think is the goal. We need to know that things are decelerating and softening, not rapidly rolling over, but you probably, 70, 80,000 a month is probably where the Fed is targeting.
Okay, so if we don't see that, what's the risk? What's the response from the Fed?
The risk is you keep leaking 25 basis point hikes as the labor market doesn't slow down. So if the data continues to moderate and inflation continues to fall, that's your hike and pause in March scenario. But the stronger the labor market stays, the more cautious they will be about inflation, and the more they're likely to stay on hold. And those cuts the market is looking for in the second half of the year don't materialize.
When we talk about the employment market, it feels like it's segmented in many different ways. You have perhaps the people who work on the ground in jobs that were not fillable during the pandemic. I think about service sector. I think about some of the fulfillment centers. And a lot of people have not been laid off, even as companies struggle, simply because they're worried about not being able to rehire them. How much is this a structural change that means a more fully employed base, even in a negative economic outlook?
So I think that's right. I think most of us have that in our forecast. We certainly do. And so, like what I'll say, from a foreseeable horizon, 2 to 3 years out, maybe even 4 years out, I think this condition persists. So I think that's absolutely right. It's why we look for a tick lower in hours worked on Friday, not necessarily a material weakening in hiring, right? So you'd reduce temporary hires first. You'd slow down hours, right? So if you were labor hoarding, those are the things that you would do first, right, to manage your labor input. We think we'll see more of that on Friday.
So do you think that there's a structural obstacle to getting inflation back to 2% that is underappreciated by people who are seeing the deceleration and kind of cheering that on?
Yeah, the immaculate disinflation story that you mentioned would require, I think, some of this going away or labor supply picking up, right? So I do think the wage story and the services story, which is what the Fed's been focusing on, is where persistence to inflation would come from. So yes, goods prices are falling, and that's great. And we've all been expecting and hoping for that. And that's what's really bringing headline lower. But to get it all the way back down to the Fed's comfort zone, we'll see. That's less clear at this point.
We're speaking with Michael Gapin of Bank of America Securities at a time when a lot of people think that this is an inflection point. We have a host of economic data. We have FOMC, ECB, and Bank of England decisions. And we also have China, the first week after the Lunar New Year, what this reopening actually looks like. From your vantage point, where will we see the reopening? Will it be more in terms of the increase in demand from Chinese consumers, or more in terms of the demand for commodities pushing up prices and causing some more inflation?
I mean, certainly from my purview and what I look for in terms of how it would affect the U.S. outlook, it's the latter. Because, as we all know, energy prices transmit pretty quickly into gasoline prices and to consumer balance sheets. So if a China reopening comes forcefully and it pushes commodity prices higher, that could actually be, a material drag on the consumer. We saw that in the first half of last year. We got tailwinds in the second half of last year from that. So I think it's less important about a global growth narrative from my mind than what happens to commodity prices.
I'm looking right now at gasoline prices, $3.50 on average for a gallon, from a low back in December of about $3 a gallon. How much do you watch this in terms of what that does to consumer spending?
It's one of the most critical things we watch, so the discretionary versus non-discretionary component. Last year, when gasoline prices and food prices were surging, we saw the rest of the consumer consumption bundle take a step back. So for me, it's very important, right? So obviously we were at about $5 a gallon. It fell all the way back to kind of March 2020, pre-Russia invasion Ukraine levels, right? So that was a tailwind for the consumer for a lot of the second half of last year. We're not thinking that continues, right? We've probably normalized. The question is, do we go from 350 to 4, or do we kind of bounce around at 3.5?
What would that look like in terms of both recession, inflation, and the Fed's actions?
Well, it would mean the rate of decline in headline inflation would start to slow. Base effects would be less favorable in that regard. And then, yes, it would take the edge off of consumption on the margin. We're seeing consumption moderate, right? Most of us have that baked into our forecasts, and we're kind of saying, hey, what are tailwinds and have been tailwinds to the consumer should start turning into headwinds. And so that would be a headwind story.
On the flip side, one of the difficult aspects of getting your head around this particular market is that there are different segments that are moving in this economy at completely different different paces. And I think about housing. We already saw a real deceleration there, and now we're starting to see it kind of even out in terms of the negative and the positive news. Is this a turn, or is this just basically a pause before housing continues to deteriorate?
I would say I think we've probably had the peak deterioration. I'm not ready to say I think housing makes the turn just yet. Mortgage rates are still pretty high, and home prices have come down a little, but not a lot. I still think the affordability shock is there. So, Maybe housing is a little less frozen than it was a couple of months ago, but I'm not ready to say housing is on the turn upward. So certainly I expect it to turn up before the broader economy does. I'm just not sure we're there in Q1.
Do you think that the Fed could actually end up getting north of 5.25%, even with everything that's baked into markets where people are basically not even believing the Fed will get to 5%?
Yes, because I think if you look at the labor market alone, I think it's easy to conclude you're going to get above 5 to 5.25, which is what we think the terminal will be. On the other side, the manufacturing data is slowing. Industrial production's fallen for 2 months in a row. So the slowdown is broadening beyond housing into the goods sector. Inflation's coming down. Again, that's your hike in March and pause story. But if you look at the labor markets alone, yes, I think it's easy to conclude there's still upside risk to the Fed's path.
Michael Gapin, thank you so much for being with us. Michael Gapin of Bank of America Securities. Interesting about the jobs report, the non-farm payrolls, it having to be below 100,000, potentially even 70,000 for a number of months in a row. The expectation for this month from Bank of America, north of 220,000. So perhaps a bit of distance between what the Fed would like to see, not on a human level, but on an economic level versus what's real on the ground. Coming up, Michael O'Rourke, Chief Market Strategist at Jones Trading, as we try to get our heads around how long this tech-driven rally can continue in the face of a Fed that may push back pretty aggressively on Wednesday. Right now, we are seeing a bit of softening, down about 0.75% on the S&P. We're looking at 40.48. We've got yields in the 10-year up 5 basis points to 3.55%. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden will meet with House Speaker Kevin McCarthy Wednesday to discuss raising the debt ceiling and avoiding a U.S. default. Republicans want a deal that includes government spending cuts. The president has refused to negotiate over the debt limit. In Ukraine, authorities say a Russian missile hit a residential building in Kharkiv, the country's second largest city. At least one person was killed, 3 wounded. 2 weeks ago, a Russian missile hit an apartment building in the city of Dnipro, killing 45 people. In Malaysia, Prime Minister Anwar Ibrahim demanded that Goldman Sachs honor its multi-billion-dollar settlement with the government for its role in the 1MDB scandal. Anwar spoke to Bloomberg's Haslinda Amin in her first interview with international media since becoming prime minister.
I think Goldman Sachs should come out clean and deal with Malaysia. Don't think that you can, dismiss this as something small that you can just use your strength to dictate your terms.
Goldman has said that if it can't reach an agreement with Malaysia on the dispute, it will be settled by arbitration. Well, Ford is responding to Tesla's recent price cuts. The automaker is slashing the price of its electric Mustang Mach-E by an average of $4,500. That discount comes on a model that Ford already described as unprofitable. Analysts predict the pace of growth for electric vehicles will slow this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
there's so many signs that the economy is likely to head into recession, but it's going to take a while. And that's been the hallmark of this whole cycle. Every stage has taken longer and gone farther than you expect. We think this rally could last us through mid-year.
That was Steve Chivarone, head of multi-asset solutions at Federated Hermes, really reflecting what a lot of people have been saying, the new consensus perhaps that this strength can last for longer than many people had expected, that the dip and rip is now rip and dip, or maybe just a sustained rally into the end of the year before perhaps some of the ongoing tightening really takes full effect. We're seeing markets a little bit softer after an incredible rally led by the tech names, and that really has stood out to me. And today you are seeing a disproportionate sell-off in the NASDAQ. The S&P down 0.8% now, 40 of 50. And this really does come on the heels of perhaps a little bit of an increase in yields, but otherwise stability, 3.55% for the 10-year, which really raises a question of how much there is a direct correlation between bond yields and tech stocks, that when bond yields go down, tech stocks rally, and vice versa. Michael O'Rourke, Chief Market Strategist at Jones Trading, joining us now. And I want to start there after an incredible rally led by those tech names that a lot of people had really discounted or written off by the end of last year. How much is this a direct correlation of yields on bonds going lower?
I think we're seeing a lot of model-driven trading that is setting up that trade. When bond yields drop, they buy technology shares. You get into those long-dated growth names. But like I said, I think it's more mechanical. I think it's systematic. I don't think it's something that's going to be sustainable, because obviously, when you look at earnings season, how earnings have played out, the fundamental story is not there. I think we entered 2023 with a lot of pent-up demand among stock investors, and that they were well behaved in 2022, knowing the environment was a little bit gloomy. So they wanted to put money to work, and they've done it thus far early in 2023. But you're looking at 7 mega cap names driving 50% of the S&P 500 gain year to date. And that's including Microsoft, who basically had a disappointing earnings call. So, like I said, I think it's still happening, but I don't think it's sustainable.
Let's dig into the earnings side of things. You said so far we really haven't seen incredible earnings. How important are the earnings that we're going to see later this week? Meta on Wednesday, Apple, Amazon, and Alphabet all coming out on Thursday.
Yeah, I'm calling it AAA Thursday. You're talking about 3 mega cap names that represent about 12 or 13% of the S&P 500. They do 1.2 trillion in revenues. So when you look at Amazon, Google or Alphabet, and Apple, that's going to be a big day, and I think that's going to set the tone for earnings season. While the markets responded well even amidst bad news on the earnings front, I think that's going to set the tone going forward. And again, it's really hard to sit there and say anyone's going to have a great outlook, because there's still so much uncertainty as to how things are going to play out in 2023.
What concerns you more, the consumer side of the tech picture or the macro picture, the idea of businesses and how much they're investing in the cloud, in other kinds of basic infrastructure?
Well, I think a lot of what we saw coming out of the pandemic was, I think, very similar to the 1999-2000 technology bubble. You had a lot of investment into these high growth areas, these new areas that people didn't realize would commercialize pretty quickly. And I think that overspend and that overbuild is obviously, we've seen a lot of that unwind in 2022. I think we're going to see more of that. And I think when you look at Intel's numbers last week, you're seeing some of that weakness emerge among the bigger names. And I think that's going to be a problem going forward. But also, you're looking at, as of last week when we got the PCE report, this is the first time since 2019, and there was only a small brief period that we had a neutral Fed funds rate, where we've had a negative Fed funds rate, negative real Fed funds rate most of the time, since early 2008. So we're getting to the point where we're going to have a positive real Fed funds rate, which is actual real tightening emerging in the economy for the first time in a long time, and that should be a headwind for the market.
So if we do get perhaps some hawkish discussion from Fed Chair Jay Powell on Wednesday, perhaps pushing back against some of the rally that we've seen, will markets take notice? Will they listen? Will they actually sell off? And will you see a tightening in financial conditions?
Well, you're 100% right. That's a big question, but it's funny. As of Friday's close, the Goldman Sachs Financial Conditions Index is at its lowest level since Jay Powell gave his Jackson Hole speech back in August. So we've had obviously at least 100 basis points in Fed funds increases. I think the Fed's balance sheet's shrunk by 4% since then, but we're not seeing financial conditions tighten. So we get a 25 basis point rate hike Wednesday. That will put us in a positive real Fed funds rate environment. But the question is, how much more will the Fed need to do? And I think when you start seeing the markets react to the hawkishness of the Fed in a meaningful way, that will give them room to be a little more cautious or be a little more tentative with rate hikes. But while the market continues to ignore policy in the direction we're heading, I think you're going to see them err on the side of hawkishness rather than just let markets continue to ignore the fundamentals, basically.
Talking about the fundamentals, a lot of people heading into 2023 were talking about margin compression and the likelihood that companies would have to pare back some of the price gains or the price increases in order to cater to consumers that were struggling a bit more. We just got this headline, Lisa Mateo was talking about it, Ford cutting the price of its electric Mustang models in response to Tesla and their price cuts. Their price cuts, some people had speculated, were really to try to corner a market. How much are you looking at this type of mini price war, mini price cutting kinds of battles that really shrink margins more than anything else in the earnings?
Well, I mean, that's an incredible headline because obviously the Tesla price cuts started at the end of last year to obviously firm up their fourth quarter. Tesla's shares traded, I think it was around $105, $106 a couple of weeks ago. They went out last week at 179, I believe. So we've had a 70% rally in Tesla shares in 3 weeks. And then you have this Ford headline today where you have a price war going on. I mean, price wars are not good for, they're not good for business. They're not good for margins. Obviously, that type of competition should not be good for share prices. But what we've seen over the past 2 to 3 weeks is the market, because financial conditions remain easy, has ignored those fundamental developments that have been going on for at least a month now.
Well, yeah. Earlier in the day by about 1%, up about 0.4%, perhaps, being seen as the winner in this particular war as Ford capitulates on the price-cutting side. On a larger scale, though, we're going to be getting auto manufacturing and auto sales numbers this week. And how much is that really important to see what the demand is like, how strong that consumer really is?
Yeah, I think we're all, everyone's girding for, is concerned about a potential recession out there. We haven't seen a slowdown in jobs, so we have seen some softer economic data. The interesting thing, this whole situation seems to be taking much longer to play out than investors realize. So I think that's another aspect of when you look at where the stock market is. Like, we hit 4-decade highs in inflation, and we're only just getting back to a neutral policy rate. These things don't reverse overnight. So I think we'll keep an eye on the consumer because obviously that's the key component of the economy. But I also don't think it's falling out of bed right away. And that just reinforces the Fed's higher for longer message, which is something that this market hasn't been accustomed to for the past 15 years.
So just real quick here, what would be your top trading recommendation given what we've seen so far in 2023?
Oh, I think investors should take, you've been given this rally that was, I call it basically unearned. I think you should take profits here and be a little more defensive. I still like sectors like the financials, and I think the banks are in good shape. But I think there's still, there's a long way to go here for 2023 to play out, and it's not going to be straight up the way the first 3 weeks have been.
Long European banks?
I like U.S. banks more, but obviously there's a big trade going on with people favoring Europe over the U.S. right now, and I think that has to do with the valuation difference that's going on there, and obviously there was a bit of a hope that the ECB will interest rates there will peak at a lower level, but I prefer the U.S. banks, but again I still would just be cautious overall.
Michael O'Rourke of Jones Trading, thank you so much for being with us. I was mentioning European banks. Barclays analysts came out with a long potentially for those banks. So right now we are seeing shares move lower more broadly. Interesting headline that we were talking about with Ford kind of joining in with some of the price cuts that we have seen. We're not seeing those price cuts in the airline space. Coming up, we do have tomorrow on Bloomberg Television what we were talking about, an exclusive interview with Dave Calhoun, Boeing President and Chief Executive Officer. Today there was
good news out of that company. They expect travel to really reach pre-COVID levels due to the reopening in China. We will build on that in that interview tomorrow. From New York, this is Bloomberg.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Up big on the year, down on the session, live from New York City this morning. Good morning, good morning. Equity futures right now down 0.8% on the S&P. A big week ahead. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, Fed Chair Jay Powell ready to downshift to smaller hikes, waiting to see if cracks appear in the labor market data, and looking ahead to earnings from Apple, Meta, and Amazon. We begin with the big issue. What a week.
We're at the beginning of an exciting week. There's so many events. A big week for earnings results across the board. There's a ton of earnings, all these other things. Got a slew of macro data.
Payrolls number.
The three major central banks.
The Bank of England. Maybe the ECB is going to be a little bit more aggressive.
A very important meeting for the Fed.
We do worry that the market's got a little bit ahead of itself.
The market is trying to call the Fed's bluff.
But then Powell is very likely to remind the market that the Fed's plan is to stay hawkish.
I am in the camp that says, that Chair Powell is going to push back aggressively
around this bullish narrative.
I would expect that he would push back against these financial conditions.
Can't imagine that, with the Fed particularly, that Powell loves to see everything flying higher.
Let's start the week's conversation right now with MUFG's George Goncalves and Jim Bianco of Bianco Research. Jim, first to you. Great to catch up with you, buddy. Wednesday, what are you looking from Chairman Powell?
Well, I'm looking for, a lot of people are looking for, is that he'll push back on the loosening of financial conditions, that the stock market has been up a lot, bonds have recovered, and that he might be afraid that will spur a wealth effect. The issue, though, is how does he push back on it? The Fed's already said that they're within 75 basis points of being done with raising rates. Does he raise 50? That would be a shock, but he'd be done, or very close to being done at that point. Does he open the door that the terminal rate might be higher than 5.25? That would be a major change. So I get it. He'll push back, but when you've already announced that you're almost at your target, there's not a whole lot of things you can push back with.
That's the question, Jim. George, help us answer it. If the Fed chair is asked whether we've seen an unwarranted easing of financial conditions, if he's asked that question on Wednesday, A, how does he answer it? And B, are you going to pay any attention to what he has to say?
Absolutely. I think he's going to push back to Jim's point. I think everybody else is kind of on the same page. It's hard to kind of just focus on the incremental rate hikes. He's going to focus on the cumulative effects of the 7 supersized hikes last year, and the fact that they're going to finish close to 5%. I think emphasizing on the level, they're going to stay higher for longer, and they're going to keep reminding us that maybe this is an opportunity to mention that the balance sheet is going to continue to tighten through quantitative tightening.
Well, George, you have the Fed going from hawkish to dovish pretty quickly. Why is that?
I mean, largely because we cannot afford higher rates in the U.S., but I do think that the bond market is getting ahead of itself. First, let's kind of see if anything breaks before we pass judgment.
Picking up on what you've got to say on this, Jim, I think the narrative and attention should turn to how far down we're going to go, not whether inflation has peaked. Do you reckon the chairman's going to reinforce that on Wednesday?
Yeah, I do. I think that's been kind of his main message that's been lost. I mean, we've got everybody yelling peak, peak, peak. And yeah, inflation has peaked, but it wasn't going to stay at 9% forever. The real question is can it get to the Fed's long-run goal of 2% on its own without a recession? If that can happen, and still the 3-month rate on core inflation is still 3%, so it even hasn't achieved it yet. But if it can happen, then we could definitely see the Fed back off. But if we wind up seeing inflation bottom at a level like 3.5%, and then the base effects that are pushing it down by July start turning higher, then I think the Fed is going to be reinforced on this idea that they have to stay higher for longer and maybe even visit the terminal rate at that point.
Well, Jim, there's another question to put to this, and I think it addresses what you're trying to look at. It's whether unemployment, which is currently at 3.5%, needs to climb through 4.5% or maybe even higher to get inflation somewhere in the vicinity of 2%. Do you think it does?
Well, yeah, I think that is the key. The Fed has invented a new statistic called Services X Shelter to look at inflation, and that is driven by employment. But the problem with employment is, if you look at the big headline numbers, initial claims at a 9-month low, 10.2 million open jobs, 3.5% unemployment rate, like you said, there's very little evidence that there's a problem in the labor market now. Now, maybe one develops, and if the one is going to develop and we're going to get a 4.5% inflation rate or unemployment rate, say by mid-late year, that's a gigantic leap in the unemployment rate in 1 year. That would be not a soft landing. That would probably be a bigger than average recession to get it to rise that much over that short a period of time.
Well, claims last week were 186,000. George Goncalves, let me come to you on that. Mike McKee and I talked about this a little bit earlier this morning. At the end of August, the Jackson Hole address from Chairman Powell talked about the pain still to come. 186,000. If I'm looking at jobless claims, I'm asking, where's the pain, George?
Look, the cumulative claims are rising, although initial claims are not. And we have to ask ourselves, kind of the composition of the labor force has changed. And it's still hard to tell if the tech losses that have been mounting for the last couple of months, when are those job losses really going to show up in the numbers? So I think that we're living in this ambiguous time period. But yeah, I mean, I think Jim's right that the fact that as long as those numbers hold, then the Fed has to stay on the hawkish side, at least maintain rates at a higher level until we actually see the labor market relent.
Equity futures right now down 0.8% on the S&P. On the Nasdaq, we're lower by 1.15%. Looking at the bond market, yields a bit higher throughout this morning. On the session, up 4 basis points on a 10-year to 3.55 on a 2-year on the screen. 4.25 on a 2-year, up 5 basis points. Mike McKee, central bank after central bank. It's not just the Fed this week; it's the BOE and the ECB.
Yeah, remember when the jobs report was a big number of the week? we have all this going on before we even get there, and it's important to keep in mind that this all matters because, as Jay Powell puts it, what happens in Europe or in the UK reflects back on the U.S. economy and vice versa, especially the U.S. Here's some context for you. This is where we are on the right-hand side as far as rates at those 3 central banks, the highest in 15 years, much higher than we saw. It's a little yellow bump there towards the left-hand side. That was the European financial crisis. That was the Eurozone crisis. You can see that we haven't had this kind of tightening in a very long time. So what kind of impact is it going to have on a cumulative basis? That's what has to be figured in, and that's what the Fed will be talking about when they start meeting tomorrow. You take a look at what they're going to be doing. Pretty much the Fed is locked in at 25, and the ECB and BOE, the markets think will do 50. And then the question is, when do they get to their peak rate and start going the other direction? Looks like the summer is the time for that, and the first cut would be November and December for the Fed and the Bank of England. 2024 is where the markets are maybe first pricing the ECB. So we're going to have high rates for longer, which is what the Fed wants you to believe. And this is where Jay Powell's going to talk about on Wednesday. He's going to be talking about not so much what the terminal rate is, not so much what they'll do at the next meeting, although he will definitely leave it open to raise rates and talk about being data dependent. But the idea is they're going to keep rates high for a long time. You were just talking about that because they want to make sure that they get down below 3%, get headed towards 2%. So their argument is going to be, we're keeping rates steady, and you've got to buy into that. And as you can see from the yellow line there, the markets do not buy into that right now. It'll be interesting to see if that changes come Thursday.
Mike, just briefly, how do you think that takes shape in the statement that we get from the Federal Reserve? They have this line in there about ongoing increases. Does that change at all?
Don't think that one changes. I think they're going to talk about ongoing rate moves, because I think the reaction in the markets to any kind of change would be very counterproductive for the Fed at this point.
Mike McKee, thank you. 4 weeks of big gains in this equity market. Futures are lower right now by 0.8%, but check out the year-to-date moves we've seen so far worldwide. Euro Stoxx 50 year-to-date up 9%. Nasdaq 100 up more than 11%. EM equities absolutely flying. Big question too. Do you fade it or do you chase it? Wall Street and the big debate taking shape this morning. Morgan Stanley and JP Morgan on the one side saying beware of the Fed and telling investors to fade this move higher. HSBC and Federated on the other chasing the rally. If I pick 2 quotes, let's start with Mike Wilson, and I'll compare that to Max Kettner over at HSBC. This is Wilson of Morgan Stanley this morning. We think the recent price action is more of a reflection of the seasonal January effect and short covering. Investors seem to have forgotten the cardinal rule of don't fight the Fed. Perhaps this week will serve as a reminder. That's one side of the debate. Here's the other. Max Kettner, HSBC, publishing this morning. Hawkish surprises could upset some of the bullish repricing. It won't take much to prompt a short-term setback for risk assets. This won't change our first half view. In fact, we'd rather increase exposure to risk assets during such setbacks. Jim Bianco, I want to come to you on that. Are you in the Max Kettner camp or the Mike Wilson camp?
I'm probably closer to the Mike Wilson camp. I've been trained not fight the Fed. That has always been a good strategy. This market has been driven by the perceptions of liquidity and interest rates. And if the Fed is going to stay higher for longer and push back on the idea that easing financial conditions is not what they want, that is a tough thing to really fight against. And I think ultimately that is where the market is going to really run into trouble.
Nothing changes a consensus narrative quite like a 4-week rally in the equity market. George, your thoughts on which camp you're in?
Look, I'm also, I guess, in the more defensive camp as well. Look, it's a technical feature of the markets at the beginning of the year. We have also vol declining, so that's really allowing for investors to leverage up and really giving a false sense of confidence. And I'm concerned that investors are now going to extrapolate the sort of gains we had at the beginning of the year as really the start of a bull run. And in fact, this is just a bear market rally.
It's not just equities, though, George. It's credit, too. You see scope for wider spreads. High-yield spreads, you say, will widen, and yet spreads have been tighter over the last few months. George, why do you think that is?
I mean, because, look, it really comes down to the fact that the economy hasn't really shown severe cracks that will result in credit losses. I mean, and that takes time to kind of show up. So, again, this is the kind of ambiguous time period between the peaking of tightening of financial conditions from the Fed side, at least from raising rates, versus a market that doesn't want to believe it and has an inverted curve and expects them to cut. I mean, the two cannot last for too much longer. And I think the Fed's going to push back, and that's going to push cuts further into 24. I think you finally get a sell-off in risk assets in the back of that.
George, what will force the market to believe it?
Look, I think that a combination of either you have the growth impulse that's coming out of China, which everybody's hanging their hat on, that that's going to be a pro-growth, that maybe Europe is in much better shape, and that we don't get the weakness in the jobs market until later in the year, and the Fed just keeps talking the tough talk.
Or it's just the data. Andrew Hollenhorst, the Citi, talked about this morning when he published. He said, we expect upcoming stronger core inflation to challenge this most recent version of the transitory inflation narrative. Jim, I caught up with Andrew Balls at PIMCO last week. It wasn't his base case, but he certainly thought it was the risk for this year, that inflation just stays sticky, more elevated than people expect. When you speak to clients, how receptive, Jim, are they with that view?
They're kind of all over the lot when it comes to that view. There's a number of them that think that, inflation will get back to 2% and others that don't. But to your point, I think that is really the question. As I said earlier, it's not that inflation peaked. We know that. Is it going to 2%? And why would it be going to 2%, or why would it not be going to 2%? And ultimately, the discussion really comes around the reopening of the economy, both China and the West, in a post-COVID. Are we in a post-COVID economy, meaning it is not 2019 anymore? If that's the case, you could make the case that inflation will stay persistent above 2%. Or are we doing like the chairman of Boeing just said, oh, we're all going to return to 2019, and it's all going to be just like it used to be, and then the inflation rate will also go back to 2% as well. That's really the question, and I tend to think more in the persistent camp that it's a post-COVID economy. It's different than it was pre-COVID, and we're not going back there.
Well, tech investors hopefully hope that we go back to 2019, Jim. To your point, have we seen real regime change? That's the issue right now for many people. Jim, George, sticking with us. Equities right now down by 0.75%. Coming up, fresh data giving Europe a dose of reality.
The market has now priced in a much better situation than it was supposed to be. There are still headwinds coming, and as we move into certainly into the summer and the autumn, we could have another phase of the energy crisis.
That conversation up next.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
The market has now priced in a much better situation than it was supposed to be. Look at the performance of European stocks this year relative to US, so that the market has been buying into this far better than expected story for Europe. There are still headwinds coming, and as we move into certainly into the summer and the autumn, we could have another phase of the energy crisis.
The recent strength in global equities facing a test this morning. In Europe, Spanish CPI coming in hot, German GDP coming in soft, souring sentiment and pouring some cold water on this year's optimism as the reopening rally stalls in China after 3 months of monster gains in Chinese ADRs, casinos and even airlines. The team coverage starts right now with Maria Tadeo in Brussels, Katie Lyons here in New York. Katie, first to you. The rally stalls just a little bit.
Yeah, once Chinese traders were back at their desks after the Lunar New Year holiday, we saw the worst day for the Hang Seng Tech Index and Hang Seng China Enterprise Index going all the way back to October, so about 3 months. We do, though, John, have to keep those moves in the wider context, which is that tech index is up 72%, or at least it was through yesterday. Since its low in October, was trading at the highest in July. The Enterprises Index trading at the highest level since June before today. All of that, of course, fueled by the optimism about the Chinese economy reopening. Today, though, that Hang Seng China Enterprise Index saw all but 4 of the 50 stocks down on the day within it. The big underperformance from the big tech companies like Tencent, Alibaba, Bilibili, all of which dropped in the range of between 7 and 8.5%. Again, though, since the lows for these stocks going back to October, they have had astounding rallies. Alibaba up about 77%, adding $145 billion to its market cap. For Tencent, we've seen $250 billion plus added to its value. So perhaps it's not all too surprising to see some profit taking coming in here. A few analysts in research notes today have essentially said these tech and internet stocks are near the completion of their valuation recovery. Now they need earnings to fully support them. So we'll see if the fundamentals also support the outperformance of these stocks versus the rest of the world. The tech index up 11% so far this year. Asia stocks more broadly up 9%. And then the MSCI Emerging Markets Index, which of course China has about a third of the weighting of that, is higher by 9%. Compare that to a gain of just 6% for the S&P 500.
The move has been ridiculous. That's 4 weeks when we talk about year to date. That's 4 weeks. The 3-month move, massive over in China. Maria, I have to say, a bit of a reality check for the constructive view on Europe this morning.
Yeah, remember it was the start of the year. We had that call from Goldman Sachs. There won't be a recession. Today, the data, however, points to accelerating inflation. When you look at the Spanish print that came out today, we were expecting it to cool down. In fact, it accelerated. Of course, core inflation also seems to be sticky, although I should stress that core inflation is measured in Spain slightly different compared to its peers. This was the flash reading, so I really want to see the details at the end of the month. And then you have Germany pointing to a slight contraction. So accelerating inflation and then Germany in a slight contraction. I should also note we were expected to get German inflation this week, and we are not going to get it because they've had, allegedly, I have a statement here from the statistics office, a technical problem. So we're not going to release it before the ECB decision on Thursday. Tomorrow, Jonathan, I think we're going to get a much bigger picture, however, when we get data from Italy, the French too, and the Euro area, just to get a temperature check of just how good or how bad the situation really is.
I don't even know what that means. A technical problem, putting out CPI data, but it is what it is. Maria, thank you, alongside Kaylee. Remember the ECB and a punchy Christine Lagarde in December when she said, we're not pivoting, we're not wavering, we have more ground to cover, we have longer to go, we're in it for the long game. Jim Bianco, do you expect a repeat of President Lagarde from December this week?
Yeah, you do. I think that the ECB was slow to get off the snide in moving rates, and now they're going to do some catch-up. They're going to probably move 50, where the Fed is going to move 25. I think it's too early for them to really say that they've really got their inflation behind them. Yeah, maybe a peak like the U.S., but the question is it a persistently high level? So, yeah, I expect them to go more and not waver, at least, or give any signs of a pivot.
George, how sticky do you think the inflation story is in the Eurozone?
Look, it has potential to be very sticky, especially, as your opening comments mentioned, that it's not clear that Europe has resolved its energy problem. I mean, I think they've dodged the bullet from weather really helping them out. But, next year, again, as we get towards the winter, if China is fully back up and running, they're going to be competing for resources and energy as well. So it's like this. There's all these conflicting narratives out there that I think Europe has a much more structural problem of potential stagflation, or even if it's low-level inflation, but still higher than what they're supposed to be.
George, to your point, that word, stagflation, why is it barely being used to describe what's taking place in Europe when it's in the numbers?
Well, I mean, I think there's, again, euphoria that they've dodged the worst-case scenario. And on the back of that, I mean, the idea that we can somehow soft land, which really means no growth in the Eurozone, that to me is close enough to a recession. So I think there's this view that if we get into a kind of a growth slowdown, that it will kill the inflation, and therefore you won't have stagflation on the back half of that. I think that's, again, too premature to have that kind of conclusion.
The potential that we could get stuck down here with very, very little economic growth, Jim, and very, very sticky inflation in the Eurozone. What would guide your views on that?
Oh, I definitely think it would be more along the lines of whether or not they can get past their energy problem. As George said, they got lucky with weather. They've got huge inventories for coming into early February right now because they haven't had to use a lot of their gas. And the question is, when they get to the teeth of a normal winter and a normal usage, maybe next year, does that really start to make them have problems? So I think it's way too early to say that Europe is, not gotten past this. It might be delayed, the weakness that we're looking for in the European economy. But whether or not they've missed it altogether, I think it's too early to say.
That's what Jane Foley of Rabobank had to say last week as well, and I think we're all on the same page, Jim. Jim Bianco, George Goncalves, to the both of you, just fantastic, as always, on the global economy, on central banks, on monetary policy, and on the bond market too. Fantastic lineup later this week for you. On Fed Decision Day on this program, here are the names for you. Kathy Jones, Bob Michael, Chris Harvey, Mike Wilson. Then on to payrolls on Friday. Here's your lineup. Mohamed Al-Arian, Rick Reeder, Anastasia Amoroso, and Mike Collins. So we've got Fed Decision Day, all-star lineup, and all-star lineup for you on Jobs Day in America this Friday. Is that enough for you? We keep going through the week ahead. Payrolls on Friday, the Fed decision on Wednesday, ton of data in between, and earnings from Amazon, Meta, Alphabet, and Apple. Coming up the morning calls and later, it's too early to get bullish. That's the view from Citi's Kristen Biddley, warning investors of more downside still to come. More on that around the opening bell, 7 minutes away from the cash open. Equity futures negative 0.75% on the S&P 500. That's on the session, on the year in the last 4 weeks. Absolutely flying.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Year to date, so that's over the last 4 weeks, the S&P 500 up 6%, the Nasdaq 100 up 11%. 5 minutes away from the opening bell on the session so far. Equity futures down 0.7% on the S&P. On the Nasdaq 100, we're down by 1.1%. That's the price action. Let's get you some morning calls. We can kick things off with Berenberg upgrading Tesla to a buy. $200 price target, saying pricing concerns look misguided. We'll talk more about that in just a moment. That stock last week up 33%. up a third of 1% this morning. Your second call from Morgan Stanley upgrading Colgate to overweight, seeing an attractive buying opportunity following recent declines. And finally, Goldman resuming coverage of Coles with a sell rating, expecting the retailer to underperform due to competitive pressures. That stock is negative by about 3.5%. Coming up, earnings season ramping up with Apple, Meta, Amazon all this week. Citi's Kristen Bidley still avoiding big tech, recommending investors stay patient and defensive. That conversation up next. Your opening bout just moments away.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
as the economic picture does.
The OK is getting ready to make.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
23 seconds away from the opening bout this morning. Good morning as we grind our way towards that cash open. Equities right now down by 0.75% on the S&P, on the Nasdaq down by 1.2%, following 4 weeks of gains on the Nasdaq 100, up about 11% year to date. Unreal rally. Let's your opening bout, switch at the board and get to the bond market. Yields pushing a little bit higher right the way through the curve. Twos out to 30s through much of this morning. Your 10-year right now yields higher by 4 or 5 basis points on a 10-year to 354.95. Elsewhere in the FX market, euro dollar 108.84. Just about positive on the euro side of things, up more than 0.1%. As we've said a few times this morning, Spanish CPI comes in hot. German GDP comes in soft. The ECB on Thursday still expected to hike 50 basis points. Look out below for crude, down by 1.5%, $78.50 on WTI. About 25 seconds into the session, we're down 0.6% on the S&P. On the Nasdaq, we're down 0.9%. One stock to watch at the open is Bed Bath & Beyond. The retailer emptying shelves as it could be edging closer to bankruptcy. Bloomberg reporting it will likely face Chapter 11 without a bidder for its assets. With more, here's Abby.
And John, if you can believe it, I've actually been in one of these stores recently, and there were a lot of empty shelves, but not maybe as many as you would think. A lot of pared down inventory from days prior when this store was stocked with everything, and a piece of this unraveling. But relative to the stock, today's nearly 3% decline, or actually at this point, 1% decline. That's nothing. Down 22% last week, down 83% last year, and of course the newest developments, that idea that we are moving toward bankruptcy. The last week, the company announced that they had, in fact, defaulted on credit lines, and we also had S&P downgrading their credit. They've closed many, many stores. They announced 150 last year. At this point, it's closer to 250 that they'll be closing. This stock, not surprisingly, none of these developments all that much of a surprise. So there's a big bearish short interest in the stock, 47%, one of the highest in the S&P 500. But take a look at this stock from its peak, down 95%. Again, this points to the idea that you do have bankruptcy looming. It's amazing to think, John, that just a couple years ago, back in 2021, in the peak of meme mania, it had been a $50 stock. Now it is a $2.52 stock. Meme malaise, perhaps.
Abby, thank you. We'll keep on top of that story. Here's another one for you. Tesla. In the early part of trading, up by about 1%. Last week, up by 33%. We've asked the question, are there price cuts everybody else's problems? Ford, it might be a problem for them. Following in Tesla's footsteps, cutting the price of its electric Mustang by an average of $4,500. Kaylee has more. Hey, Kaylee.
Hey, John. Yeah, Tesla is down the better part of 2% right now on this news. It seems that they took a look at Tesla's price cuts of about 20% across its lineup and said, okay, yeah, if we want to compete, we're going to have to do that too. So that's exactly what they're doing with their electric Mustang, the Mach-E. They're cutting it, as you said, on average by about $4,500. It's a $900 cut for the cheapest model, which will now cost you just shy of $46,000 to start. The price of the GT extended range version will fall by $5,900 to start just under $64,000. So this move also will bring the Mach-E in line with a new cap on EV prices to qualify for the federal tax credits of up to $7,500 under the Inflation Reduction Act. So likely there is more than one motive here. The thing is, though, John, Ford already has described this model as unprofitable. So it raises the question of further margin pressure. Ford's gross margin of 8.5% is much tighter than Tesla's, who had a gross automotive margin of 25.9% in the fourth quarter. So Tesla, in theory, has a lot more breathing room. Ford says it's hoping to offset further deterioration in margins by boosting production by 67%. But if you're going to make more cars, you need the demand to buy them. So again, it all comes down to competition and this brave new world for legacy automakers who are now competing with Tesla, who in many ways was a first mover in this EV space. And of course, you've seen the dramatic outperformance of Tesla stock over the last 3 years as a result. That continued last week, John, as you said, with its best weekly performance going back to 2013 after it reported earnings. We get earnings from GM and Ford this week. So it'll be interesting to see what kind of catalyst and if any more pricing announcements are made, John.
Unreal moves. Kaylee, thank you. Tesla up more than 30% last week, up more than 40% year to date. Will be very interesting to look at the relative price action between Ford and Tesla through today's session. Tesla right now just about negative by 0.25%. Ford down a whole lot more than that. Dan Ives of Wedbush, a bull on the stock, said this out on Twitter just moments ago. Ford cut Mustang EV prices in response to Tesla's price cut. Mini price war about to begin with EVs in the United States. A story for us, that's for sure. Another one, big tech, under pressure going into a key earnings week. This coming as the NASDAQ 100 heads for its best January since 1999. Katie Greifeld, it's been phenomenal.
It's been phenomenal, and big tech, it is dropping like a stone today, but if you look over the past 19 trading days, the NASDAQ 100 has gained about 10% or so, and if you add that together, that's the best January this century for the index, John. So you can say it's overdone, but you can't ignore it. And if we take a look at what's leading that rally, Lucid is out front, as is Tesla, so a very 2020 feel there. Warner Brothers Discovery also more than 50% higher so far this year, and you have some chip names in there as well for some good measures. So that's the NASDAQ 100, huge rally. But if you broaden out to the S&P 500, we're talking about a 5% or so rally there as well. And typically, 5% gains in January, they've led to an average full year gain of about 21% on average in data going back to 1960. So history is on the side of the bulls, but we have two big tests in earnings and in this week's Fed decision, John. So stay tuned.
Katie, thank you. What a week ahead. I've said that about 50 times this morning. The question I'm interested in, though, is what you're interested in. Is it the Fed chair decision, the news conference on Wednesday, or is it the data on Friday if you had your pick. Nuveen's Tony Rodriguez earlier this morning saying it was all about the data for him and not about the Federal Reserve decision. I'll ask more guests that through the week as we anticipate both those things. Citi's Kristen Bidley warning investors to stay cautious, writing the following: while it may be tempting, do not become prematurely bullish. The recessionary decline in employment and corporate profits has not yet started. Corporate earnings are likely to fall 10%. That being said, there will be opportunities and better conditions to go long risk assets in the coming year. Kristen Bidley joins us right now. So Kristen, you don't like this rally. Walk me through why.
I don't like this rally. I want to, right? Any type of rally that we have that's good for risk assets, I want to be supportive of. Unfortunately, when you look at the quality of this rally, what really drove it? So going into the end of last year, you had a lot of tax loss harvesting. You also had the most bearish positioning that we've seen since the global financial crisis. And so you had very bearish positioning, a lot of selling, repositioning. And when you look at what's driving this rally, it's all of the laggards and losers from last year. And so this is more of a technical rally. It's not something that has fundamentally changed in our opinion. And we, John, happen to be in the camp of not fighting the Fed. As we have tightening financial conditions that have not flowed through, we need to be cautious.
You're not alone. Mike Wilson of Morgan Stanley saying precisely that to kick off the trading week. Kristen, can you walk me through what is on your dashboard that would need to change for you to change your mind?
Yeah, so I think it's really watching the Fed's mandate. Look, it's relatively straightforward. It's just not easy. So it's price stability and full employment. They are going to hang on to the fact that the employment backdrop still looks strong. We are focused on the data as well. So looking at the jobs report on Friday is really critical, but we don't anticipate that we're going to get anything there for the Fed to change course. On the inflation side, while many people think that inflation has peaked and is coming down, do we really think that that's going to come anywhere close to their 2% target? So to answer very directly, what needs to break? It needs to be employment. And we anticipate that is going to happen over the next couple of months, which would change the Fed's path.
So tell me what you're advocating for right now, because it's clearly not the NASDAQ 100, up 11% year to date.
So what we're advocating right now is defensive positioning. So we continue to be overweight fixed income within our portfolios relative to equities. We actually just took gains in our gold position that we've had on for about the past year, and we've reallocated both to the front end of the curve when it comes to U.S. Treasuries. Again, that's just kind of enhancing your cash yield and keeping some dry powder for when markets turn. And we also see some opportunities within European equities and Japanese equities right now, given the valuation differential, but also as a way of playing the Chinese reopening and some of that pent-up consumer spending and consumer savings that could really flow into those economies as well.
You went there, so let's talk about it. The China reopening story. I've got the MSCI China up about 60% from the lows at the end of October. I've got the Golden Dragon Index up about 85%. That's before today's price action. Kristen, and I hear everybody asking the same question. How do I play the China reopening story? Could you make the argument that it's already played out over the last 3 months?
I think you could make the argument that a lot of it has already been done, but I think you still, when you look at, depending upon what index you're using, the Chinese equity market is still trading off more than 30% off its all-time highs. And there's clearly a delineation between what's been happening in the A shares versus the H shares. So again, it's more of a flows and technical element that we could see, where we could see some upward pressure over the next couple of weeks. But again, this isn't a fundamental strategic long-term play. It's more what we saw within the U.S. economy in 2020 and the U.S. market, where you saw that really quick V-shaped recovery that was really driven by consumption. And we anticipate, like I said, whether that's playing out within the local Chinese equity markets or whether it's playing out in those tangential markets like European equities, whether that's consumer discretionary, luxury good, hospitality and leisure, or in Japanese equities, that's a way for people who aren't quite comfortable going into Chinese equities as a way of finding a valuation play that could benefit from those trends.
Kristen, you mentioned several industries there. I didn't hear mining. Why is that?
Well, I mean, look, that's one of the key areas that everyone's thinking in terms of what could ultimately be some upward pressure. I think when you look at some of the commodity activity that has already played out, we have certainly seen that in areas like copper, in other areas. So while that's not a key play right now, it's something that we're watching it very closely and keeping an eye on those trends.
Kristen, stick with us. We've got more to talk about, including the potential for bankruptcy still ahead. Equities right now, about 10 minutes into the session, lower by 0.5% on the S&P, on the NASDAQ. Great start to the year. Rough start to the morning. We're down about 1% on the NASDAQ this morning. Coming up, bankruptcy looming for Bed Bath & Beyond.
Some of the more recent indicators do suggest also some of the weekly indicators on bankruptcy filings. BCY and Bloomberg has also been deteriorating. So the conclusion is some of the latest few weeks, exactly as you're pointing out, Romain, here, have been weakening a little bit.
We'll talk about the potential for that up next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
It is still an open question whether we'll have a recession or not. But some of the more recent indicators do suggest also some of the weekly indicators on bankruptcy filings. BCY and Bloomberg has also been deteriorating. So the conclusion is some of the latest few weeks, exactly as you're pointing out, Romain, here, have been weakening a little bit.
Bed Bath & Beyond potentially inching closer to bankruptcy, the retailer receiving a default notice with creditors demanding immediate payment. A company filing revealing it, quote, does not have sufficient resources to repay the amounts, leading it to consider all strategic alternatives, including restructuring its debt. This coming as Bloomberg reports Chapter 11 could be its next stop. Katie Greifert joins us for more. Hey, Katie.
Hey, John. Well, if you thought the equity story was interesting, let's take a look at the debt, because Bed Bath & Beyond 2034 debt is trading at just 6 cents on the dollar. For context, anything below 50 cents is considered distressed, and this particular security was trading near 90 cents just a year ago. So how times have changed. But if we break down the capital structure, Bed Bath & Beyond has a market cap below $400 million compared to about $3.6 billion in debt. The bulk of that is in long-term debt, about $2.4 billion. The rest in short-dated debt. And as Chapter 11 potentially looms here, there's about $4.4 billion worth of assets that could be recovered. We know it's struggled to move into inventories, rather. That totals about $1.4 billion. Bed Bath & Beyond leases its buildings, so it doesn't own those, and that totals about $1.3 billion. All of that leaves $1.6 billion in other assets, namely its property, plant, and equivalents. Likely won't be sold at market price, so we'll see how this plays out.
Katie, you said potential for Chapter 11. How's this avoidable?
It's a great question. I'm just following the reporting. We'll see if someone steps in to buy these assets, tries to help them out of this bankruptcy, but we've been following this one for a long time.
Katie, thank you. On the latest with Bed Bath & Beyond, Silly Kristen Bidley back with us for more. Kristen, it's an odd situation where we face the potential, I say the potential for bankruptcies to pick up. Yes, from a very, very low base, but with the PMI sub 50, the potential for bankruptcies to pick up. What business does high yield credit have rallying to start the year?
I mean, it's super interesting, right? And again, this is why, John, we're playing a little bit of defense here. I don't really understand that tightening of credit that we've seen in the high yield space. I mean, you could argue that it's come in, right? Not just year to date, but for the past couple of months, we've seen that, which is why we believe we're going to see opportunities over the next couple of months, but we are certainly not going long those assets right now. When you look at the cost of capital and how that has doubled over the past 12 months, and you see this continued tightening, that of course is going to flow through not only into earnings, but into balance sheet management. And we should anticipate that we're going to see an increase there.
There is a constructive view out there. It comes from Neil Dutta of Renaissance Macro. And Neil wrote this, Kristen, this morning, just published moments ago. I'll share it with you. The Fed is staring down the barrel of an upturn in economic activity, having seen limited progress in some important metrics such as unemployment and core services ex-housing inflation, and has still decided to step down to 25, signaling that it's close to the end. I can see why markets would like this idea, but it risks the Fed having to step in later. The Fed story only works if the economy is slowing down. Sorry, but I don't see it. Kristen, could you respond to that? Your thoughts?
I actually think we're starting to see a lot of the economy slowing down. So I think a lot of the signal is just once we need to kind of get to this point when bad news is actually bad news. So like you said, purchasing managers showed contraction in both goods and services. Granted, it's one data point, but that's something we're going to keep a close eye on. We've seen a big drop in retail sales. We've seen a significant drop in new home sales. The housing market has been significantly impacted, not from a price standpoint, but obviously from a sales standpoint. And then you're seeing retailers impacted in terms of inventory bloat, less productive headcount. So all of these different signs are actually showing that the Fed's medicine is indeed working, but for it to turn up in the data in terms of their two key points, both in the employment market as well as inflation, is taking some time.
Do you see sufficient evidence for them to back off then, to back down to 25 and maybe to deliver what could be their penultimate hike?
I mean, this week, I think 25 is our base case, and I think we'll continue to see that. I don't think there's any advantage to Chair Powell right now in terms of what they hope to achieve and the targets that they have, delivering anything other than a hawkish message or potentially something that is just we're higher for longer, which is obviously still tight financial conditions. So I don't think we're going to get anything out of it this particular FOMC meeting. However, I think in March, there's a lot of data that is coming out over the next month that could actually indicate some trends within some of these areas that I mentioned. And so we're really looking out to March if there's any type of change in the rhetoric whatsoever.
So, Kristen, with that in mind, what is more important this week? Chair Powell on Wednesday or the data you get through the week, which concludes on Friday with payrolls?
The data. I think the data. I think we anticipate, like I said, that he's going to have a hawkish message. We largely think that 25 basis point hike is done and dusted. And so the data in terms of actually showing some of these cracks, some of this sustained decline is what we're really looking to. I would say the most interesting area, though, John, so part of it is wages, and we're going to keep a very, very close eye on that. But I also think we need to keep a close eye on the services data as well. Goods, we've already seen that declining. We're seeing that inventory bloat. Services has been a little bit more resilient. And so I think that's an area that we and the Fed are going to keep a close eye on.
Kristen, just finally, given that you're more focused on the data than you are on the words of Chairman Powell, does that say something about the weight of the words that Chairman Powell has these days relative to maybe a few months ago? It seems to me that I can sit here and say the most important question on Wednesday is how he responds to the question, what do you think about the easing of financial conditions? Is it warranted or unwarranted? What really matters ultimately is how this market chooses to respond to how he answers that question, Kristen. And ultimately, over the last couple of months, it seems to me at least, and others too, that when these Fed officials speak and say no cuts, no cuts, no cuts, fewer and fewer people are listening to what they've got to say.
Well, I think from my perspective, it's just that we largely are anticipating what he's going to say. So I think the message, almost the expectation is that there will be hawkish commentary. And so anything that would come in underneath that or not within those expectations could actually be a positive sign. But I think if the base case is that you expect him to be hawkish, reinforce that message, kind of going back to the minutes from the December meeting where he didn't like the fact that financial conditions were loosening and the market reaction to that. I think a lot of this is the market anticipating that and expecting that. And we're really focused, like I said, again, we're cautious, we're defensive because we're focused on the data and we're focused on that employment number really starting to break. And once we see unemployment uptick, that is something that gains momentum and it happens quickly. It's almost like everything, like all at once when you start to see that data start to flow through. And that's going to give Chair Powell and the Fed a tough decision in terms of balancing that mandate. And we believe that they're going to err on the side of making sure that the employment picture is intact.
Plenty of data still to come. Kristen Bidley of Citi. Kristen, wonderful as always. Thank you. Looking ahead to the economic data, not just Chairman Powell. If you'd like a sneak peek into payrolls Friday, I can give you our survey right now. The median estimate, moving target, we'll get more estimates through the week, but as things stand, the median estimate right now, 185K on the headline number for payrolls. The previous view, 223. On unemployment, 3.5% last time around. Looking for that to climb to 3.6%. And those of you interested in wages month on month, 0.3, looking for 0.3 again. Average hourly earnings year over year was 4.6 previously, looking for 4.3% this time around. As I say, that's a sneak peek. It's incomplete. We'll get more estimates through the week, and when that starts to move again, I'll bring you an update. Let's get you some sector price action just briefly. Here's Abby.
Hey, John. Well, we have somewhat muted sector action at this point. The S&P 500 off of its lows, down 0.4%. That Dow, which I know you don't like, but it is fluctuating higher, suggesting that maybe we're going to see something similar here. So at this point, more sectors than not are higher. Not huge gains, staples, materials, healthcare, utilities. On bottom, energy down in line with oil. It's interesting. We've been talking about Bed Bath & Beyond all morning. One sign of risk on sentiment. It has flipped higher, up 8%. We also have Carvana trading up 18%, but trading to the downside, China Tech down 4.2% overall. Some of the larger laggards there include Bilibili and Pinduoduo. But of course, that sector since October, as you know, John, off the lows, up more than 70%. Really pretty incredible.
Soft start to the week, that's for sure, Abby. Thank you. Down about a third, though. No real drama here on the S&P relative to the big gains year to date. On the Nasdaq, we're down about 0.75% on the Nasdaq right now. Up next, your trading diary from New York. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
25 minutes into the session, taking the smallest of bites out of the year-to-date rally so far. On the S&P, we're down about 0.5% on the day. On the year, up by about 5.5%. On the Nasdaq, down about 1% on the day. The Nasdaq 100 on the year is still up around about 10 full percentage points. That's the price action. Here's your trading diary. What a week ahead. Tech earnings continue. Snap, Spotify on Tuesday. Fed decision Wednesday, followed by earnings from Meta. Rate decisions from the ECB and the BOE on Thursday, plus results from Apple, Google, Amazon still to come. And then it's payrolls on Friday. From New York City, that does it for me. Packed few days ahead. Looking forward to covering it with you. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.